23, we're going to be streaming stocks, options, and futures trading today. Doing dailies on the SPY, most likely. Watching GME, barbecue, AMC, whatever comes our way. Thanks for being here. Thanks for your support. Sub up, like up, comment down. Happy Money sticks around. Follow us on Twitter at HappyMoneyYT, as well as our Discord server. Link for those are in the description. Let me get set up here a little bit. Bell is about to be on us. Bell. All right. We've kind of made this little inverse cup down here. See if we get a handle of a bounce on this today with SPY. Maybe a midday peak. I guess that's similar to how yesterday was. SPY's opening up down 0.25%. GME's pretty much flat. SPY's opening up at yesterday's lows, actually below yesterday's lows. AMC's down 1.5. ECB had a little gap up. I guess they bought back some of their convertible notes, so that's pretty bullish. Got rack space up a lot. 20% on this one. ECB's up 6. Barbecue, flat. Best doing. VFS up 1.6. Might grab some calls out of the gate here. Being that we're at the low. CP's up 7. Let's see, I can't remember, did I? Yeah, ACB is the one I stop out of. VFS up 2% there. PGC is also up. Morning, John Bennett. Not any news on barbecue that I know of, no. It's just in the expert market, so it's not really traded anymore. Very illiquid. Dish is up 2, 3. That is neat. Moss is up a bit. Let's see. AMC is down 1.5. Needs to be up 10 now. Ticker's down 1. The news on rack space. Insider purchase? No. It was 5 days ago. Oh, price target upgrade? Yeah, $3.50. climbing up here a little bit. Got birds up 9%. Dish is now 4.3. Tried to open a position on this yesterday, actually. We got filled. The options are kind of hard to get filled on, actually. I don't know. Not quite liquid enough. Actually, yeah, look at that spread. That's awful. Excuse me. Space is up 5.8. Maybe finding some support there. 4% on Dish. Alright, 10 minutes in. Appreciate you guys. Thanks for your likes. Got 5 in the morning. Spy slowly climbing up a little bit. Basically retested the pre-market from yesterday for that low. And be building a little handle on this inverse cup. There's your range on barbecue. Up 7.5 at 19 cents. It seems like the range is 17 cents to 16 cents. Sorry, 19 to 16. ACP 12% now. I wish I didn't get stopped out of the rest of those. Grab a couple puts there. See if we retest low of the day. closed one of them. And I closed the second one. 12.5% on ACB. 5.5 on space. Wow, look at that green candle. Rocket. Oh, big wick up there. Morning, Guts. AMC's kind of at that neckline. See it hold this level. %6 on space. $11.25 on ACB there. Nice bull flag. Excuse me. Estimate. Tried some puts again. Funds up 0.7. Rum is down 4.3. Break on VWAP. Buy. Alright, send a message out to the Theta Farm members. Got into one early this morning. Wow, look at that. Look at that reversal candle. Oh my. Wiki, wiki, wiki. AMC down 3. That's neckline. Excuse me. Okay, closing half there. Set a stop and the other one for break even. GME down 1.2. Dish up 5 1/4. Okay. Yawn down 1%. Getting right to that support. See if that holds. Here's the full retest of the low on the day. There's a little flush through. Got stopped out another one, unfortunately. Well. AMC testing that level. New lows there. GME down 1.5. Pumped, SPY pumped just enough to get my other contract closed. Give me down 1.8. GNS down 4. Yeah, breaking that $1 is not very bullish. Oh, ACB gave some back. Up 2.5 now. Me at 17.24. What's up, Tasty? I'm doing 0 days on SPY. You're gonna be paying a higher premium due for this week just because of FOMC tomorrow. If you go anything past today. Oh, I've been fast up a little bit. 1.5. Been holding this level pretty good. Time to rally. I feel that gap. You're low there on SPY. Down 0.42%. I missed this trade. That's okay. Sucks, but it's okay. All new half-day options expiring at 11. I mean, that's a joke. ETOO down 21%. Actually, not that much if looking at the range. NEO's down 11.25. Rocket Labs down 11. Nicola's down 11. Bye. Down 10. EBIX down 7. Low there on SPY. Expecting it to bottom out here. Maybe it'll stretch down to here. Hey, what do you know? Liquor's down 5%. Oh, Planet Fitness still getting wrecked. Top of where? Down 3. Looks like it's going back for that gap fill. Or if they decay. Do it. Nice. That's a good play, Guts. I like that. Get some FOMC exposure. It's not hard to imagine half-day options. Trade them every day, about half day. Like hourly options. Yesterday I was trading like 15-minute options. I got into options at the very end of the day. But yeah, no, that'd be crazy. They'll probably just come out with some sort of new derivative for less than a day. I saw there's an ETF now that gonna trade 0-day options. Where did I see that? I don't know. That double top on a carrier. I like this one for the long term. Head and shoulders on Datadog. Palantir down 2.5, another head and shoulders. Upstart, big head and shoulders. Wow, Nerdy's been getting wrecked. Mia almost back to its lows. All-time lows. confirm. Look at that thing. It doesn't care. Alright, GME down 2%. SPY's kind of bear flagging down here. I think we'll probably get a little bounce though. Might grab some puts on the bounce. Let's see, it's 10:15. Getting closer and closer to that midday chop that we might be getting. Gotta get the trades in and out. See, ACP's up 4. I bounced on yesterday's low actually. AMC's down 4. Yeah, this isn't looking very good. SPY, new low there, just flushed through. Alright, now I think this 440 level is probably going to get tested. From right here, this move? I don't know what that's even from. Oh. Potentially reversal there. A wick. Arms down another 5% today. Alright, SPY's bouncing. Slowly climbing up. Oh look, liquor's down 8%.
And with momentum, always kind of speaks with a little bit more severity in my mind as far as technicals go, right? It's not like we're just kind of saying, oh, you know, it's going to break through this thing and rip on the first try. This has now been kind of tried and tested, and bears and bonds didn't back down. So they're coming at it again. Right. Maybe this week with the Fed and the FOMC, we'll get some decision on that kind of trade for bonds. So if it gets rejected again and comes back down, then you would argue probably a big relief then for the stock market if we do get another rejection of this potential move in bonds around 4.4.
Yeah, it's actually more like if we get up to 4.4, I think we're in trouble. I think if we get up to 4.4, I think the odds are good that we're going to test 5. So yeah, it's kind of now or never. And like you mentioned, bonds have been just kind of languishing around this 425 area for what, weeks?
Yeah.
Several weeks.
Yep.
That's not typical rejection behavior. That's what happened last year when we got up there, right? Last year in October, we got up to around 430, and the yields fell back close to 410, 4% maybe. It happened quickly within a couple of weeks. And before you know it, we went from looking really vulnerable in the S&P 500 to people talking about starting a new rally. That was the bottom. I mean, that was the bottom almost a year ago, and we've had a heck of a rally there. So yeah, I think rates are the game. I think you want to watch the VIX. The VIX is going to let you know how spooked the market is that rates are going higher. I like to look at the 21-day moving average in the VIX. So here's our support. So let's take a look at that.
Yeah,
first.
tell me about S&Ps. If we do get that breakout in bonds, is there obvious support? You know, if stocks start dropping as yields rise, is there an obvious level that looks like maybe could support stocks, John?
Clearly, there are two. We've been sandwiched in between, we being the S&P 500, 4637 is a benchmark high from about a year ago. And we got close to that at the end of July. And then 4325, you can see on the chart, if you look all the way to the left, that's the August 2022 benchmark high. So 4325 is the first support level. That's about 2% below the market. If we break that, major support comes in at about 4,200, and you can see there's a lot of activity there. You've got the 200-day moving average there. You've got the February 2nd high there, and you also have the trend line from the October 13th low of last year, all right in the 4,200 neighborhood. That's 5% lower than where we are right now. So first support is 2% underneath where we are right now. Second support is 5% underneath. And I think unless these rates do a big about face here, I think 43.25 is pretty likely here in the near term.
Okay. So that's kind of the first step, which takes us back to that August 22 high. And we did go down and test that last month. So it's another level that's been pretty well established. That's really the technicals of the S&P holding up seems to be the major bull case at this point. In your model, the internal metrics, the rate of change for S&P is still one of the two positive indicators alongside corporate bond spreads. So it's basically the notion is that there is some turbulence kind of building in some of the stuff that could hurt stocks. But so far, the market just hasn't really responded so much. Corporate bond spreads have been fine. We haven't really seen that big recession trade, and the S&P technicals haven't broken. So it's essentially now just kind of a watching and waiting game for the levels, it seems like.
What I like to do is when the market is sideways, and we've been sideways, right? We're caught between that 46.37 and 43.25, and the tactical metrics like the VIX and monthly rate of change and some of the metrics you see in the Asbury 6, when those are kind of rocking back and forth between going positive and negative, I like to look out to the next time period. So for us, that's 63 days or one business quarter. That's strategic for us. And what we're seeing there is, I don't know if you have a chart there, I sent one this morning, but there's a number of those more strategic metrics like investor sentiment that are warning that the market is too bullish. It's too complacent. So here we go. This is a daily survey of futures trader sentiment on the S&P 500. Lower panel, all the way to the right, you can see that kind of bent arrow is showing you that these futures traders, which are near to intermediate term trend followers, they got to as bullish as 82%, and now they're backing off. And go across the chart, you can see all the red verticals are showing you similar periods where they were that bullish and then they started to back away. Those were all market tops. So I think considering the tactical part of the market is pretty flat and neutral
What's up,
right
Diggs?
now, the strategic suggests to me
Morning
the
to ya.
path of least resistance is probably down. Seasonality stays negative through the end of this month, maybe the early part of October. So we're vulnerable here. I think you have to know where your levels are. Watch the VIX. If the VIX starts trading above 1460 or about 1450 now, that's going to indicate the market is spooked enough to actually act on this gradually rising yield of the 10-year that we're seeing this morning.
All right, there it is. Appreciate it, John. Thanks for the analysis and the update on the model. We always like to keep it on our list and high up on that list, so appreciate it. Good stuff.
Thanks.
John Kosar, Chief Market Strategist at Asbury Research. 4 out of the 6 Asbury 6 metrics pointing to downside in stocks. Coming up, Chart Masters got a little earnings analysis for us. We're going to look back at AutoZone, which has been very sideways, and preview General Mills, which needs some help desperately after a big sell-off here a year running. We'll be right back.
Runs up 2%. Additional bounce buy. A red candle back down a bit. Beyond bouncing on that level. 1024. I'm out of those calls. Yeah, it's not looking good on AMC. Probably coming down to retest the lows. All-time lows. There are some catalysts though. Could pump it. Taylor Swift numbers, results from that. And workers and writers strike. Once that stops, both those could see a pump on AMC. Fingers up 9%. Stitch Fix had a nice bounce on that support. $2.80, up 7.25 now. ACB bounced up back up to VWAP, up 6.5 now. Base up 5.3. IUP is down 1.25. Not like Pac West, how's it doing? Tight consolidation.
Percent or so. Market's down overall though, so okay, it's kind of in line with what we're getting in the session. Chart-wise, are we hanging on to support here, Kevin? I mean, it seems like we've been at this 2,500 area for a while for AutoZone.
Yeah, definitely. And actually, the intraday action is really positive when it comes to the bulls here. Even though the stock is still down, we are seeing it bounce off of several different support areas that we'll go through. But if we look at a 1-year daily chart, the first thing you want to kind of keep in mind here, the stock actually has been trading in a range between 23.05 and 26.10 here. Now, we did actually see it break that range in April, but it did come back post earnings. And now the stock actually recently hit its upper end of its range last week around September 11th. Now we are seeing it pull back. Now, for today, here's the areas of support that have been able to hold, at least for now. We have the point of control, which is that the volume area on that volume profile where we see the most trading when it comes to the stock, buying and selling. That's at 24.53, spot 43 right now. We did bounce off of that level. And then we have another support area that I wanted to highlight here at 24.35. We did actually see that bounce off of that level intraday as well. I think the bottom end of that range is still going to be your primary support area if we do see this fail. And the reason is because of point C, where we have the stochastics and CCI. Now, these are really good indicators when we have ranging markets like we see in AutoZone here, but you want to be able to have both of them confirm a trend, a change in trend rather than just one. And we've actually highlighted several of them. We had one in December, January, March, and May, where the CCI turns up to oversold levels. We see the D line, or that longer moving exponential moving average for the stochastics, moving to the upline, moving to the upside here, and that's really what confirms a reversal in price. We are not there at that level yet here, Oliver, but in a couple of days, maybe we will see it start to hinge to the upside. That would confirm, a price movement to the upside, hitting that upper range once again at 26.10.
Man, talk about a lot of back and forth. I guess it could be worse. Could be down, could be looking like our next stock, General Mills, has just gotten slaughtered over the past year. So, all right, AutoZone's numbers enough to kind of keep it in the range. For General Mills, what are we looking for here, Renita? I mean, I imagine the bar's got to be pretty low at this point for this stock.
It's definitely kind of low. So adjusted earnings and revenue are expected to have fallen from last quarter, and we're looking for adjusted earnings of $1.08 on revenue. That will be $4.88 billion. That would be a 3.5% rise from last year's report, but a drop from last quarter.
Okay.
One major thing General Mills has been dealing with is higher costs, their cost inflation. They've had the gross margin, the adjusted gross margin was hurt partially because of the higher input costs. And input cost inflation was actually 9% in the prior quarter. The company had said on its earnings call last quarter that it was cost inflation along with the consumer's economic status, as we will, of course, hear a lot more about as the days march on, along with the rising stability, actually, of the supply chain status. Those things will be the biggest factors impacting 2024 fiscal year. Now, for this fiscal year, General Mills is expecting input cost inflation of 5% over the full year, and that would be 5% of the total costs of goods that are actually sold. So we'll look out to find out how the company is tempering its spending, if it has to, whether or not they have any initiatives in place to try to bring down some of their costs.
That's the main impetus right now for them to turn the stock around, it seems like, is try and get that under control, because it's just been falling like a rock, and as a staple, it's certainly not doing its job for investors. How do we even begin to analyze a chart like this, Kevin?
Well, it's kind of easy, Oliver. We just continue to move out when it comes to time frames. So instead of looking at a daily, we are going to look at a 3-year weekly chart to try to highlight some areas of support, because once again, on the daily chart, you're just not going to be able to do it. So point A, we are looking at this downward channel line here. It has been intact. It's very, very small when you're looking at the range, but unfortunately, we have seen only brief areas of support that have been broken through, like the $75 level. Now, For point B, let's highlight some areas of support if this trend continues to move to the downside here. The first one I'm looking at is $66. Next one is $62.20. And then we are looking at the point of control on the volume profile here, $60.45. Last but not least, that $57 level. You do not really want to see that stock hit that level, Oliver, because it does portend that this stock could actually remain at that level for a very long time. Last but not least, you're probably like, hey, look at the CCI, look at the RSI. This might be a chance for a little bit of a bullish move to the upside here. Well, that's not really the case. So RSI and CCI do really well in ranging markets, but when we are seeing downward moving markets like we are in General Mills, it could actually distort the oscillators in themselves, and that's what we're kind of looking at right now. And in fact, if you look in the past, and you can actually see the RSI at these levels actually does not indicate a bottom at all. In fact, it actually does continue to move to the downside. So I would say the downside is still intact. Got to kind of keep these areas of support that I highlighted, in your mind here. And I think, not even talking from the technical standpoint, when we do hear the conference call, you're going to have to start hearing about the dividend yield. And if we do see any type of cut to that, then that could also create more catalysts to the downside here, Albert.
Yeah, that's like death blow type of stuff at this point for stock that's already had this amount of trouble. I mean, here's the thing is that that's where all the volume is the last 3 years is down here. So I like the perspective because it kind of seems like maybe the exception to the rule was when we were trading up in that, $70 plus area, basically.
Yeah, definitely. And you can actually see a relationship, and I didn't put it on the chart. You can look at the relationship between General Mills and maybe even some of the input goods or the commodities like wheat or even oats. And actually, I looked at that relationship, and yes, there seems to be a strong relationship, and both of those products have fallen off of the cliff as well. And we do not see a bottom when it comes to both oats and wheat. That could also, once again, foretell that General Mills may have some headwinds in the near future here, but that also could lower input costs a year out or 2 years out, if you will, because they order that far out in advance in order to make their products.
All right. Nice look at the chart. Appreciate the technical look. Kevin Green, thanks for the setup. Rita, for the numbers. When we come back, let's get that update on Disney as shares have been struggling. Of course, that's been long term, but today, too, a fresh blow to the stock after a couple good days. It was starting to look better for Disney. Then they reminded us just how much they're going to have to spend to right the ship. We'll be right back to get the update from Caroline. Then we'll talk about stocks under some pressure with their market meetup. NASDAQ now down about 1%, so we do have some meaningful selling.
Little bounce around SPY. Hit a new low. I did actually grab some puts on that drop. When I closed out of those calls, I grabbed puts. I closed one down here. Still trying to be small with my position sizing. AMC down 5.5. Added to some puts there. Hey, Julian. Yeah. Give me a bounce up. Whap. Up 1.25. They just kind of sold off some. It's only up 2.7 now.
Expenses that are beyond what had already been priced in or outlined, because I mean, like, logically this perfectly follows what they've told us, you know, which is that they're
Already
going
did
to
have
try and invigorate the business
Sounds
outside
good.
of just the streaming side. And I've kind of been thinking also that, like, why didn't we hear more about this? They should be, you know, really trying to wring out everything they can from their other businesses. So the fact the market doesn't like this is like, what would the market like exactly?
Cost cuts. They don't want to hear about Disney spending any more money. Obviously, they're still losing money on the streaming side, but it's also a down day for the street, so it could just be kind of participating in some of the broader selling as well. But it certainly is a company with a lot of headwinds that still have yet to be figured out.
True. All right. 60 billion of fresh spending in streaming. Okay, I can get why the market would hate it, but like cruises, parks, I mean, the kind of old reliable stuff should, you know, be able to make some money off of it eventually. But all right, tough crowd.
Some of it will be used to keep bears out of Disney World. I don't know if you saw that story yesterday, Oliver. They had to close certain rides at Disney World because there was a black bear in a tree at Disney World. I mean,
That's awesome.
is literally my nightmare. When I go hiking, I'm always scared of bears.
That makes me want to go
see one at Disney World.
It's perfect. We're literally the opposite. I'm talking about going on a poker cruise. You're like, it's the worst thing ever. And I want to go to Disney when there's a bear in there. That's like my draw. That's why I go hiking. I'm looking for bears.
Oh my goodness. Yeah.
Thanks. Appreciate
Maybe
it.
some barbecue moves. Day every day.
Let's bring in a market.
You're probably not gonna see
Dan
much while it's an
Grant, Nick
expert.
Dirakis. There's real bears, by the way. There's market bears and there's scary bears. Nick Dirakis, Dan Grant. I'm not sure if either of them qualify as bears. I think Dan Grant might be a little bit of a bond bear, perhaps here. Are we going to get some action here this week, Dan Grant? What do you think?
I like the fact that Disney reacted to these increase in spending instantly, right straight down.
Yeah, right. Market's got no tolerance.
Really pulled back.
No tolerance.
We had housing starts kind of disappoint, showing continued weakness this morning. Bond market really hasn't had any kind of pullback in yield. We're sitting right towards the high end of the range, 441. And I don't think we've been here since 2015.
Bonds caught a little bit of a bid there as stocks came off
the low, yeah.
Which is maybe a little reassuring. That's what bonds are supposed to do.
In theory, we have the 2-year up at almost 5.7.
Yeah, on expert, I mean, it's so liquid. It's just huge spread. So
that's got to be concerning as well.
no one can really
because
buy
that's
it. No one
gravitating
retail.
towards the Fed window. And is the Fed going to go tomorrow? Probably not, really. And they're not going to raise rates tomorrow.
The 2-year is just looking like, I mean, it's itching for a breakout here. What do you think has to happen tomorrow for us to get that breakout, Nick?
Well, obviously a surprise, either way from the Fed would give us something.
Right, we know they're not going to hike.
That aside, I think So barring a shock like that, I think we need to hear more of that hawkishness, and that November is on the table, guys. I think that there's almost a coin flip chance here of a November hike, and it was up a bit, it's down a bit. I think we need to hear a little bit more direction and how they've interpreted some of the data that's come in over the past month and a half, because it has been there has been further upward
selling one of those contracts.
We've interpreted all of that as
putting a stop on the other one for break even.
The last mile kind of down is the hardest to get to. What are they going to say about that now that that's come to fruition? So I think if you're going to see rates push higher here, and we really do get a breakout on rates, bonds down, rates up, I think that's something we're going to have to get clarity on. The flip side is also true. If they're saying, hey, this is exactly what we expected, and this is going to take a while, but we're already restrictive and we're waiting for that to work its way through the system. If they give any kind of thought that we're not going to raise, I think you could see rates come in a bit and a bond rally. There's an interesting kind of positioning out there in the market, and I'm sure Dan's got a take on this, but this basis trade is real, right? The futures versus the cash, and there's been so much activity and so many large short positions taken on rate futures. Sometimes these things are a little bit, the tail is wagging the dog, right? There's some huge positions out there in the futures market, particularly with shorts, short bets out there on rates and within these hedge funds, and I think that's an interesting dynamic to keep an eye on here, because sometimes markets get disjointed based on positions that are taken and not so much by policy. So I think we got to keep a real careful eye here on rate.
Should have left one for a runner. Oh well.
Yeah, how do they not push up the expectations on the margin, Dan, given everything that's happened since the last meeting, moving crude, almost like the least of them, but the employment data, the economic data, which continued to beat expectations. We got services going back higher. You look at all like the PMI ISM charts, they went like this, and then now they're going like this. I mean, Fed's got to have some respect for those data points, don't they?
I think the Fed would ignore crude except for the strength in the dollar.
Yeah, right.
Right, because if the strength of the dollar
can't.
Yeah, dollar strength and the dollar strength and crude going up, it's kind of a double whammy, and commodity prices are showing you that the dollar is showing strength. They are reacting to a stronger dollar with lower commodity prices.
Yeah.
And, talking about a bumper crop in corn coming, and it's sure not showing it in the price.
Hey, Nick, give us a closing 30-second thought, sir. What else is on your mind? We got Instacart. We got what?
Yeah, I think it's a very quiet 1% sell-off in the Nasdaq.
Yeah, it is.
The rate conversation dovetails right into tech. Right, we're down 1%. Oil's above 91. It's not just a bond story here. Equities are definitely feeling the pressure, and yeah, absolutely. Instacart looking for a follow-through on what we saw from ARM, and a nice stable offering here to help continue to thaw that IPO market that's been pretty dormant for years now. So very interested to see when that one comes out.
All right. Nice, thanks. Appreciate the thoughts, guys. Dan Grant, Nick Theodorakis. Thank you for joining me, Oliver Rennick, for Morning Trade Live. See you this afternoon. Market on closes at 2 p.m. Trading 360 with Nicole Petalides is up next.
left at least one runner. You have one option. Helps you to not want to jump back in. Keeps you from overtrading. Just one open contract. Yeah, it might be bounced on that level. Teladoc down 1%. Man, this thing just flushed through those levels.
Right now at 19.55 a troy ounce. And Bitcoin 27,000, back to that 27,000 handle, 285, and the dollar 104.70. For a look at some of the top moving stocks in today's market, I'm joined by Jenny Horn, markets correspondent here on Schwab Network, taking a look at Instacart. It's here. We've been talking about this, I would say, for a year or two. But today is the day. Tell us how it's shaping up.
Today is the day, Nicole, and it does seem like, at least based on expectations, where the company was pricing its IPO at $30 a share, that does imply some upsides. They previously had been expecting around $9.3 billion at the high end of their range, but this $30 a share open would put it at a $10 billion valuation. So that would be definitely positive here. There were about 22 million shares sold in their initial public offering, with around 14 million coming from the company and just around 8 million coming from existing shareholders. Now, mind you, what I think is so interesting about Instacart, because this is an 11-year-old company, not necessarily a new company by any means, but in the early 2021, during the peak of the pandemic, when this name was seeing such success, they raised money at a $39 billion valuation, or $125 a share, from prominent venture firms and asset managers. So this company has then sacrificed a lot of its growth to remain more cost efficient as of late. They saw revenue surge as much as 600% during the pandemic, and then their most recently reported quarter, revenue was up 15%. So we have started
That's
to
a
see
tiny
things
float, 1.1 million
normalize
shares.
here. But what we do know is
That might be a
with this
squeezy
now $10 IPO
IPO.
price, or $30 IPO price, and $10 billion valuation, it does trade at about 3.5 times
Should be
its
volatile.
forward revenue, which is slightly below DoorDash and slightly
Be a nice
ahead
day
of,
trade,
say,
actually.
Uber, which does own Uber Eats. So still waiting on things here for how they shape up. But we are expecting to see the first trade on the NASDAQ under ticker symbol CART.
Yeah, and we'll have a guest later in the show
I
talking
might day
all
trade that.
about IPOs. So John Jerome will join us from IPO Edge later in the show. Also, you're keeping an eye on all things Apple.
at the lows
and
again.
There's a lot of talk about the demand for iPhone 15. Tell us more about that.
A little bit of a mixed picture, I'd say, but the note we got today out of Goldman definitely positive, as they did tell investors that Apple was moving quickly from their iPhone 15 launch date on September 22nd to an excess of 8 weeks for select phones and regions, suggesting that demand is now outpacing supply. They did maintain their buy rating and a $216 price target, which implies about 20% upside from where we closed on Monday. They overall view the extended lead times for the iPhone 15 Pro,
Jenny sounds like she's getting that China cough.
Max, as a positive indication of consumer demand for increasing their price and overall mix. They did note, however, though, that supply could be impacted by potential supply chain constraints, particularly on that Pro Max. And I will say that I was part of the pre-sale frenzy when their store was initially not working, and we did see that. I placed an order right around 7:30 a.m. Central Time, so right when they opened, and then within an hour they had already had their iPhone 15 Pro Max delayed out until November for delivery. So I got it at early October, thank goodness, but that just goes to show how quickly people were part of the pre-sales. I mean, this name, it basically crashed their website per se, so it's really fascinating to watch. Apple shares modestly lower today, and of course seeing this pull back about 10.5% from their 52-week highs.
Yeah, good for you. Early bird gets the worm. That's what I always tell my kids. And the truth of the matter is, I mean, I think Apple always does this with the new phones. They just sort of never have enough, and that creates more and more buzz, particularly, you know, because they do this in September and then the holidays come, and they're masterminds at marketing and getting everybody excited. Thank you so much, Jenny Horn, markets correspondent. Great to see you. Thank you. Let's get some insights in the news shaping the markets. It's Fed week. Okay, tomorrow is Fed Day. Jay Woods, Chief Global Strategist, Freedom Capital Markets, is here with us. Thank you so much for being here. So tell me, I mean, what do you think we might hear tomorrow? I mean, I don't know that we'll see a price hike, a rate hike. Yeah. Your thoughts?
Yeah, no, I think a pause is in the cards, and that's what we're curious to hear. What is the tone going to be going forward? We're going to see if he's hawkish. Everyone's talking now about a possible quarter hike in November. It's almost a 50-50 coin flip whether or not they raise. Yeah. But what are we going to hear? We're going to hear consistency in his tone. In fact, we're going to look at every data point to point to point. So now we'll be focused on the CPI, the PPI, PCE, right. The same things he usually does. The more interesting point to me is going to be the dot plot comes out tomorrow, and that will give you a broad range as to see where all the Fed voters and non-voters for that matter think rates are going to be going forward. Is it still in line with what we had? Where do we see a potential cut in the next few months to years? And that will probably be the story when we come out of it.
So at this point now, it's interesting because yesterday I had a guest who said, look, the labor market's so tight. Mm-hmm. It's perfect. We're almost at full employment was the point he was making. Yet inflation is still sort of prevalent. It's not at those 40-year highs, but still it's there. You have the UAW shutdown, which is going to push automobiles higher. You've had energy running hot. His view was that it probably won't be the end if you raise a quarter point or half a point even. Other than commercial real estate or whatever, that certainly feels like a tough area. But what are your thoughts? I mean, Can we absorb another 25 or 50 basis points?
I think we can absorb another 25, possibly 50, and those are all concerns. The headlines have been awful lately, you know, and you add that onto the seasonal time of September being that toughest month, and then October being historically known for some rough days, but we tend to start off October a little rough and finish strong. The auto worker strike right now, that's limited to about 10% of the total workforce. It's 3 plants, 1 plant in each of the big 3. Let's see how that develops. But yes, it could have a deeper impact if it prolongs. The writer strike is something we don't talk enough about, but that has been going on for quite some time. Still no end in sight there.
Yeah.
It's starting to you see Disney about to make 52-week lows. Netflix looks like it's breaking down. So there's been an impact there. And then the jobs number, it's slowly ticking up. So, you know, it's too soon to use a word like stagflation, but this is something that we could see, you know, in the next quarter if things remain on the trajectory we're seeing right now.
Yeah, I mean, pertaining to the writers and actors strike, which was the first time that the two had a strike at the
Starting
same
to scale in his
time in
calls
60
very
years.
slowly.
And if
I know it's
they don't
11, so
settle
I'm
that
probably be holding
soon,
these through
then
the
you're
chop.
going into 2024 production, very
Very
problematic,
slowly.
and a lot of jobs and work
One at a
lost.
time, maybe
The
one an hour.
UAW strike certainly
Depending on the
doesn't
price
seem
action,
to
of course.
be ending anytime soon. The last one was 40 days. How worried are you about that and any ramifications that could occur there?
Well, if it goes wider, like right now, there are 143,000 workers in the union.
Yeah.
One at the Ford, GM, Stellantis, 1 plant each on strike. If it expands, then it will have an impact. So right now,
well, that could happen on Friday. I mean, they said it could happen.
and we could have a
Friday.
government
GME's up
shutdown
above
at
BWAP
the end
now.
of, end of the month. So, like I said, the headlines right
AMC
now,
is climbing
with
back
the
up to
seasonal
BWAP.
headwinds, this is a disaster for what we could see as, you know, a major drop in some of the averages.
Yeah.
Right now, we're not seeing it. In fact, yesterday we just extended a streak, the longest streak since 2018, where the
Jeez, look at
S&P
that monthly
500
candle on
hasn't
Planet
had
Fitness.
a 1.5% decline. So we still
This
haven't
is like
had
new
that,
CEO
big
news still?
drop or any panic in the market. But right now, things are starting to turn a little negative. I think it's still apropos for the course. I'm watching 43.50 right now, short term in the S&P 500.
Hearing that this is
and
the
then
cheapest gym,
4,200
though,
is my line in the sand.
makes
If
me kind of
something
bullish
breaks
on
us
it.
below that 4,200 level, which was very big
Cheap.
resistance
Cheap
for a
is
long
gonna be
period of
good.
time, then I'll change my tune. But if we do pull back, it's awful when you're going through it. I still think this is normal, but with those headwinds, it could turn into something bigger, so we're watching.
So, look, there's plenty of people who believe in a stock market rally at the end of the year, known as the Santa Claus rally. Some people are saying about a cut. As you look at the dot plots, that'll help you, but dot plot, you'll see whether or not there are some cuts next year. That being said, what's your advice to investors? I mean, you have Apple and some great news there. You have, you know, all things. You have the Magnificent Seven. If people say to you, "What should I do? I want to put money to work, or should I take profits? What should I do?"
Well, in the Magnificent Seven, well, it's sector by sector. I think some of those stocks like NVIDIA, the semiconductors, they've been under pressure lately. They're giving some back, but they're still up a tremendous amount year to date. If you have profits there, it's not a bad time to take some and then wait for a better entry. I think NVIDIA is a perfect example, a stock that had great earnings and failed to go any higher. It's pulling back. I think 400 would be a level there. So the Magnificent Seven, they're slowing down. They've had a great run. And then look for rotation. Look for safety. Utilities, healthcare, staples. Staples, very interesting to me. We're starting to see them finally pick their head up. Same with utilities over the last 2 weeks. That's what you see. That's the rotation you see when things are a little skittish. So that has me a little concerned. And then chasing performance end of the year. You will skim off some of the winners and you'll chase performance. Watch General Mills tomorrow. The stock is down 21% year to date, but they have earnings out. It's at a key level support-wise to the 65, 66 level. It's down 30% just since the middle of the summer. If that can break the trend, you can see some of these staples start to rally. Costco's next week as well. That's a staple that has done very well and on the verge of breaking out higher. That could be the safe way to go if you're a little skittish in this market, but I don't think the technology and I don't think the AI story is over. I just think we're on pause right now.
Right. Good to see you, Jay Woods.
Always great to see you.
Thank you for being here in person, Freedom Capital Markets. Thank you, Jay Woods. All right, up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals.
Lichtenstein.
Takes us to the trades for Microsoft, the gold ETF, and one more, the Russell ETF. There it is. We'll be right back.
The valuation on Roblox is crazy. I mean, I see it, like I get it. It's 16.25 billion market cap. They barely make, what, 2 billion a year in revenue at a loss. At a loss of 1 billion. At a low though, so. I added one call. I know I didn't wait an hour that time, but it has held up better than I thought it would have. Could still get new lows here, but without more of a bounce, I don't think it's going to be much. So either bounce to make new lows or reversal for afternoon. Was Dash gonna sell off on the Instacart IPO? What we're seeing. I've seen a couple All Stars in real life. I didn't realize they were so prevalent. Seems like they've sold quite a few of them. I think Hertz uses them for rental.
The reason for a bullish trade in gold, look, the dollar has been absolutely explosive to the upside. So I look at gold, and yeah, gold has definitely been a little bit languishing behind, again, because of ultimately the strong dollar. But gold has just not been crushed. And at this point in time, a bullish trade in gold seems to make sense from purely a risk reward perspective. If the US dollar is to turn around and head back down to any degree, I believe that gold could actually sustain some significant upside. Or if inflation, if there's even like a discussion tomorrow of like inflation isn't necessarily dead, they move the dot plot out a little further, right? So rates higher for longer. Anything, any rhetoric along those lines are going to be very bullish for gold. With that, I'm out to, again, the December 15 expiration. I'm going to be in GLD buying the 185 call, selling the 190 call. So it's a $5 wide spread. This one's actually done for a $1.21 debit. Nice shot to the upside with plenty of time to let it come to fruition.
All right. Let's hear what Ben says about the chart. Ben, your thoughts, GLD?
Nicole, the chart is very supportive of that narrative, a bullish narrative that is. There hasn't been a lot of conviction as of recent as the dollar's been kind of teetering around this 105, 104.50 level, but taking a look here, we just had a recent test of the 175 area, which held, and I think that was key. We'll talk about the bigger picture and why in just a second, but first and foremost, taking a look here, as I noticed since basically the middle of August, when we were trading down around 174, we rallied up to 181, came back down, and I thought it was important that we held above that mid-August low, unable to take that out. So you've got a pretty well-defined lower extreme established at 175. You've got your upper extreme at 181. Do the math, it's pretty basic. The pivot here is 178, but let's not dwell too much on the 178 area, more so that lower extreme 175. And why do I say that? Because you take a look here at this longer term chart, we've got daily candles up here now. We're going back to the beginning of October. You can see we came off that 150 level where we had been kind of consolidating around 155. You see the conviction throughout November, December, into the beginning of the year when we actually topped out February, March, up around that 200 level or just shy of. Sideways consolidation. I mentioned the significance of 175. You can notice a couple tests of that key level right here. Again, just a pivot level in terms of based on that wider range that we're in. Let me show you one more chart here, taking a step back and look at the weekly time frame. This really solidifies that bullish narrative. Holding again above 175, you can see the areas of consolidation that formed this chart here. This has been supportive of the bullish narrative all the way since the summer of 2014 when we were bottoming out here around 100, and you can see migration of value to the upside, currently consolidating around 175. Above that, opening up a door for a retest of the 200 level again.
All right, and you show that bullish trend over the long term, at least there. Don, any final thoughts on this one? I know you're watching the dollar as well.
Yeah, you know, I don't say this lightly, but the dollar has literally exploded to the upside. I mean, it's one of the most vertical charts pretty much on any trader's screen. It is astounding to me how little gold has actually had in terms of an impact of such a strong dollar. And it's one of the reasons that I think at this point in time, look, we could take some very near-term pain being long gold, but in the end, I think it, from a risk-reward perspective, does stand some nice upside potential.
That's crazy.
Okay, next up, Microsoft, which hit a high of 366 not that long ago. Why? And raising the dividend, right, today. Tell me more about Microsoft.
Yeah, I'm actually taking again another bearish position inside of Microsoft. So there's, to me, a very critical technical level inside of Microsoft, and that deals exclusively with the 320s. Right. So at 320 and below, I think that if we actually break that, there's going to be considerably more downside trajectory to Microsoft. And, you know, right now, I think that we're seeing AI kind of fizzle out. You're seeing it in NVIDIA, you're seeing it a little bit in Microsoft. It's languishing at this point. So that AI narrative, if it kind of fades a little bit, we'll go through 320 on Microsoft and again, sustain some significant downside. With that, once again, I'm all the way out to the December 15th expiration on this particular trade. So this is a point in time where, look, as traders, you know, you be honest with yourself. Like, you're not going to be able to see what's coming right in front of you. But if the narrative actually holds true for a more significant period of time, I think we're actually positioned very well. So again, I'm going to create a spread for a more significant period of time, give myself to be a little, you know, time to be right, time to be wrong, time to laugh, time to cry. December 15th, I'm going to go out and buy the 315 puts. I'm going to sell the 305 puts. So I'm going for a $10 wide put spread. And this trade is done for a $2.65 debit. So again, it's a defined risk trade. I'm negating a lot of the volatility risk, ultimately using a spread in here and giving myself ample time to be right, and us to actually pierce through that 320 level on Microsoft that I find so critical.
Yeah, and you know, obviously you're really banking on some volatility too, because Microsoft has been a name that people love. Now they have raised their dividend 10%. You know,
forever.
That would be some catalysts for the upside, but as you said, you're giving it time to have that volatility and move lower. Ben, your thoughts on the Microsoft chart, please.
A little bit of weakness on the more intraday time frame. Recently just broke down at a key pivot level on the more intermediate time frame, but still what I see is a longer term trend to the upside. Let's just begin with that bearish narrative and where I think it comes from. Again, when you look at this chart, you can see we're going back here just a few days when we were up around 340. You can see a couple areas of consolidation that we formed at lower and lower levels. And then you can also see the conviction associated with the trade to the downside here today. Question is, will we start to balance at a new lower level that we can basically validate that working assumption that these areas of consolidation that continue to move at lower and lower levels? If we don't, if we V-bottom back up, the bears don't want to see this thing back above 332, because that would signal a bit of a shift here and a rejection of that 324 low that we've seen so far today. Here's where you can start to see that bullish longer term trend starting to play out, but you can also see, as I mentioned, how we're holding below a key pivot level around 335. In fact, we failed here a couple times, potentially setting up a bit of a head and shoulders pattern that would be very supportive of Don's bearish narrative. But in my opinion, as long as we hold above 307, we're still in this longer term, in this case, a more intermediate term time frame to the upside. Don was talking 320. For me, it's more 335 and then 307, which is, I guess, kind of right on the outer extremes of that 320 level. But taking a look here at Microsoft, this is what really stands out to me. We always talk about the significance of auction market theories, these concepts, the principles that I use to view price activity, the lens I view them through, or it through. But here you can see how it helps us determine trend, right, to the downside. But it also helps us determine when we've reversed that, because on the way down, we were establishing areas of consolidation to the downside. And while we were balancing around 232, we were referencing 266. We broke through that back in March of this year. Everything to the upside since has been very bullish, and I don't see a reversal as of yet on this longer term chart.
Yeah, and look, when we broke through a big green candle right there. And sort of
shows the energy.
Yeah, it really does. Thank you for that. John, final thoughts, and we're going to do Russell 2000, looking at the small caps, that ETF. Your thoughts on that?
Sure. Let's jump right over to the Russell. So inside of the Russell, I think we're seeing a degree of a technical breakdown right now. And again, I'm not much more of a technician. I'm much more of a quantitative trader. Nevertheless, I think most of us are actually looking at, again, what appears to be a significant technical breakdown. You can actually see a head and shoulders there on the daily, and heavy volatility inside of the IWM in the last couple of weeks.
Coming down here a little bit.
Implied volatility finally starting to pick up in there as well. The traded hand is again out to the December 15th. So as you mentioned a little earlier, Nicole, I am looking for fairly substantial volatility once again to kind of, reign large inside of this marketplace. And we might be seeing some of the forefronts of that in today's marketplace. Obviously, seasonality does have an impact here. We're in late September. We're ready to rock in this marketplace. And I think it's befitting at this point. The Magnificent Seven has been just that. We're seeing a little bit of fade in a handful of those stocks, but the Russell here is, again, it's under duress. This trade, again, December 15th expiration. I am buying the 176 puts. I am selling the 166 puts. So I'm going a full $10 wide spread in here. I always use spreads to mitigate the volatility exposure. So as volatility expands out, look, I just want to define my risk. I want to get in, I want to get out. This $10 wide spread is done for a $1.95 debit. It is a very nice shot, if you will, to the downside. If you sit here and think to yourself, look, I think the markets could break down. There are so many headwinds that need I even begin to mention them just in the next couple of weeks, everything from strikes to government shutdown. We could go on and on this particular
It's up where
front.
it bounced. Upwards up 13.5.
Understood. And so with that, your thoughts, because a lot of people love to have the small caps in their portfolio, a good diversification tool, but they really, obviously, it could go to the downside here, particularly if you watch this dollar. Your thoughts, Ben?
Well, it has been going to the downside recently. A similar situation in terms of Microsoft, where we have some more a shorter-term weakness, but that longer-term time frame still suggestive of a trend to the upside. Let's just begin with that shorter-term weakness, because it's really starting to accelerate here, and it's supportive of Don's narrative in terms of the high conviction trade we've seen, not only to the downside over the last couple weeks, but look at the breakout that's coming into play right now. You've got lower lows, lower highs, red candles, and again, a vertical phase out of a balance area that just recently formed around 184. So we're in continuation of the pattern that we have been seeing. You can see top left corner up around 190. one where we balanced, and then again the high conviction move that we're seeing here to the downside. As you take a step back, you can see a very similar pattern playing out, a little bit of weakness on the daily candle chart, and I'd imagine this is the head and shoulders pattern that Don was talking about. I actually see a couple on this chart as I look at the daily time frame, but recently you've got, looks like a couple shoulders around the 195 level, the head being up around that 200 area. Again, significance of the 180 area. Should you open up the door to the downside and take out 180, opens up a door for a retest of those lower extremes, a fall from last year lows that we saw. That was down around 165, 170. I want to show you though, as I mentioned here, that longer term trend to the upside still somewhat bullish. Now, this is what I went ahead and looked at here, an area of conviction that had been forming at a higher and higher level, 140 up to 220, but then you can see some weakness coming into play while we're still holding above 140. I did want to show you another possible scenario, and I think this is kind of the most bullish scenario here, where you eventually kind of work your way higher off this lower level and sort of establish a larger area of consolidation around 200. But yeah, seeing this area of consolidation, again, kind of getting back to this chart, not necessarily what the bulls wanted to see, because again, you've broken down from 220 now, still holding above 140, but not very supportive of that really strong energy, that strength, that high conviction to the upside. So I can understand Don's narrative in this one, the approach towards trying to take advantage of some of the weakness we've seen as of recent.
Yeah, and that's what we have been seeing, and we just have a lot of, balls in the air versus catalysts to give us the move higher at this time. So thank you both very much for the big three today. Ben Lichtenstein there on the chart.
Lichtenstein.
Of course, Don Kaufman, co-founder of TheoTrade. Thank you both. Coming up next, time to spotlight the
Trade with
IPO
sharks.
market. Everything from ARM to CART, Instacart. A lot of IPO names that you got to keep your eyes on this
Give me
radar.
above VWAP.
Next.
With a bit of a green candle. AMC is also above VWAP. That is neat. UTII is up 8.5. Upper 11. ACB came back down. It's only up 2 now. I like VFS's support it's built. Very strong. Space up 7.25. Due for a big bounce back to 50 moving average. Let's see what news was on rum. I don't see anything. GME climbing up a little bit there. It's almost flat on the day. It's only down 0.6. More chop and consolidation.
Is starting to really come in alignment. We actually saw a huge drawdown when it came to supply for equipment during the COVID-19 pandemic, and it's been a long road trying to match that demand in the street. Now they are actually seeing maybe a little bit more of an equilibrium, and that's why Evercore ISI is really calling that out.
I'm in some more here.
Right, thank you.
Got 30 minutes for another buy-in.
Good to see you. 2 downgrades, important ones today. Thank you. All right, let's turn our attention over to the IPO market. Of course, we're waiting on Instacart. It seems moments away. I mean, it's up 38% in the indications. ARM Holdings, another name that certainly reinvigorated investor interest overall because that is still trading above its IPO price. So let's get more on the IPO buzz. Joining me right now, John Janarone, Editor-in-Chief, Publisher, IPO Edge. Thank you, John, for being with us. I do want to talk about ARM and anything else in the lineup, but of course Instacart is the one that's really front and center right now. And at 41.50 or so, it's up about 38% in the indications. What do you think, and what does it tell you in the big picture?
Hi. Well, first of all, Nicole, it's good to be back. It's been a little quiet in the IPO front for a couple of years now. So this is really positive, Nicole. I mean, as you pointed out, ARM traded well last week. Saw that one, and it's at about 55, so it's 10% higher. This one looks like it's going to open way up. You're right. I mean, at least 30%, so north of $40 a share. So what I would say is this is a very good sign for the IPO market. You're getting companies that make money, so they get valuation support, and these bankers are pricing them to work. There was a time when bankers were afraid of leaving money on the table, but I think that the mindset among most players in the marketplace right now is to make sure that these first few deals go well through as the window reopens.
Right. We also had ARM, as you mentioned. That was a $51 IPO. It jumped up. It's been selling off. It's still holding around $55. And in the tech land, and that was part of the testing of the waters to see if people were interested in tech once again. What was your takeaway?
Well, I think that what's interesting about this is you call these down round IPOs. This is the thing that I think is getting a lot of attention in the press here. This company was valued at 3 or 4 times as much in the last round. So there are a lot of investors who bought in that round who are way, way down in their original investment. So I think what we're going to have to see is more rational pricing these tech companies. But look, just if I can talk numbers real quick, at $30 a share, we were talking about 15 times 2024 EBITDA. Now that it's going to open up this much higher, it's trading kind of in line with DoorDash. So once again, I'd caution particularly individual retail investors to look at where it's trading now, not the IPO price. You can't get it there.
Oh, well, of course, and you won't, and you never do, really. I mean, unless you know someone or something, you pretty much never get the IPO price. We have one coming here tomorrow, KVYO, and that's $7.3 billion. And these are unicorns in that they're,
you
they're
closed
big
5 minutes
enough,
ago.
That's a good thing. It's in marketing software. Had you heard
If the
about
market
that
moves
one
on
at
that.
all?
Thanks, guys, for your likes. We're at 13 on the day.
Here at the NYSE.
Yeah, I do. I think that a lot depends on how CART does, actually. I mean, this is a very, very fragile moment in time, trying to get all the stars to align here. So before I get too excited about that one, I want to see how CART trades. Again, I think it's going to open just a few more minutes here. But just one other thing on CART I'd like to point out. This is a unicorn, Nicole, but this is a tough business they're in. These grocery stores that they work with, their margins are so thin that it's really expensive and painful to the bottom line to work with some of these third-party guys. And so, it's going to be a tough road to navigate going forward.
Good
There's
point.
some partnerships that look fantastic, and those are more among the regional grocers. So say down here in Florida, like Publix, these guys basically power their entire e-commerce platform. Some of the bigger guys like Walmart, they will never need Instacart. They do it all themselves. So I just wanted to point out that it's a pretty competitive landscape out there, and this is not a slam dunk business. I mean, you want to keep an eye on it. I think it's a fantastic one, and glad to see it going public. But
Thanks, Guts.
it's difficult out there.
Yeah,
Streets are hard out there.
Kava has taken a turn for the worst. Month to date, down 25% and at $32. So, don't love that for folks because they probably got excited when they saw it in the $50 range, and now it's in the $30 range. We also had Kenvue, which was the spinoff from J&J, Birkenstock, Reddit. Tell me anything more that you think we need to watch going forward.
Let's keep a close eye on the two that are out there already. But then I'd say Birkenstock is interesting. And again, as you can probably guess, knowing what that footwear is like, that's not a tech company. It's a more straightforward business that probably makes a good amount of money. So I think we'll see more of those along the way. But by the way, I just want to tell your viewers, just check out our website, ipo-edge.com. We're going to be following all these big deals. And in fact, we have a conference focused on IPOs coming up in a couple months. You can read about there too. So we'll be keeping a track of all of these here, Nicole.
So just which is the biggest one to watch after CART? Which one of all the names this year is the one that you think might get the most interest quickly?
I think
Watch this quickly.
Interesting one, Nicole, because it's going to show how the market responds to a company that's got good fundamentals and is not so speculative. And if you can see some of those deals start to work, then I think over time, perhaps what bankers tell me, it's more of a 2024 story. You're going to see some of the riskier tech companies come in. But these businesses that we're looking at here are pretty well established. So I'd like to keep an eye on the ones that are established. So, the two that are out there, and then I'm going to watch Birkenstock closely.
Okay, and we see the indications of 41.70 now, so still holding on strong here for CART. John Janarone, IPO Edge. Thanks for being here today. A big day to have you on. Appreciate it. All right, coming up next, the disruptor, Supermicro computer stock. Well, that's up 200% this year. We'll find out why one analyst added an over.
You're saying put that in the title? I probably should start putting that in the title. I don't want people to think it's a trigger channel though. I'm not trying to give alerts and triggers. I do sometimes, my entries and exits, but I don't want anybody to be trying to follow my trades. But yeah, that could help. Close one of these calls. I'm closing the other one. Okay, now we see if this is really head and shoulders, or if we're gonna actually reverse and the VWAP and make an inverse head and shoulders here. It's like middle of the day though. Be worth it to not even be in it. Live or die by the FOMO.
Talk about Supermicro Microcomputer, which is up 300% in 1 year. People would love that. And Barclays still thinks there's some room to the upside. Tell us more about that.
Yeah, I think so, Nicole. I mean, when I think of Supermicro, I think of sort of a stealth NVIDIA play. I mean, this is a company that's performed exceptionally well. Year to date, it's up about 200%, as you mentioned, about 52 weeks, up over 300%. But effectively, they provide high performance cloud computing, storage, and networking and database management, everything that has to do with artificial intelligence and help supporting the back-end systems for artificial intelligence. So high performance server technologies is really what Supermicro provides a marketplace, and they compete with behemoths out there like IBM, Hewlett Packard Enterprises, and Dell.
And it's middle of the day.
Today, Barclays
I don't see much
very
good risk reward.
Stock. They actually
maybe a little today.
Coverage with an
maybe a little
rating
flush,
on the
but
name. And the price target about $327. And I think if you look at Supermicro's not only technologies, but if you look at their growth rates in the past year or so, I can see why the stock is up over 300%. They had EBITDA growth over 100% in the past 4 quarters combined, with sales that improved to about 40% year-over-year growth. And this is again comparing the last 4 quarters to the previous 4 quarters. But if you look at the forward estimates for earnings growth for Supermicro, they're still expecting 50% EBITDA growth in the next 4 quarters. Now that's certainly down compared to last year, but so is the stock price. The stock has actually fallen, if you look at the chart, in the past 30 days or so, by about $100. It was around $350. Now it's trading around $250. But if you look at, again, the forward multiple on the stock compared to that growth rate of 50%, it's only trading around 15 times forward earnings. So I think this is a call on valuation, as well as the fact that the company's growth is still very promising. I think their high performance server technologies is really in high demand, and it won't matter really if it's just NVIDIA's support system, if you will, from their graphics chips interface. I think
for titles too, I don't know how many people are like searching for that. That's more what I think about, like keyword searches.
Server technology, and that's effectively why
but yeah, maybe if someone saw it and saw that
really sort of
title, it'd be more enticing.
In this AI push we've seen in the last year.
Need someone to make thumbnails for me.
Unbelievable. So those AI relationships and more helping that to give it a possible boost. Right now, it's up.
Market's slow right now. It's summer. There's not much excitement for retail anyway, so it's across the board regardless.
Yeah. So Nicole, if you look at the VIX just quickly, the VIX really doesn't demonstrate what I've noticed in the past few weeks. There's a lot of intraday volatility. So I think the markets are still going to be relatively volatile and weak, perhaps as we move into the budget renegotiations or reconciliation coming up at the end of the month. So with that said, we're going to sell premium still in this market environment.
Down, testing the low.
I think the give back from the August levels around 350 is actually quite rewarding right now.
Through.
It's actually trading right above its 100-day moving average. So I think that's also potentially an area of support, and that lies around $235. So what we're going to do in this case is go out to October with about 30 days to expiration, and we're going to sell basically a put spread here with selling the $235 put and simultaneously buying the $225 put below that. So ideally speaking, the whole objective here is
the day on
selling this for $3.50. We want it to stay, in terms of the stock price, above 235. Now break even
call close and put open ended up working out perfect.
And the total risk on this trade is $6.50, and that only occurs if the stock trades at 225 or lower by expiration in 30 days. So if you think the stock is going to hold levels right around that 100-day moving average between now and let's say the next 30 days, this is certainly a trade you could consider. It's not necessarily an aggressively bullish trade. It's basically selling for 350, and of course having
stop loss in the last one.
Of course, volatility erode
as
we get closer to expiration.
All right, thank you for that. Good luck there, Supermicrocomputer. Appreciate it, George Sillis, with our disruptor every single day. Up next, a look at the energy sector. Crude oil at the highest levels, over $92.
There, now I don't have to think about it.
Closer to 93. Will it go to 100? What do we need to know? Our panel is ready.
Might try and trade cart IPO. I like how small the float is. It has hype. Could be good. ARM did pretty well, given ARM wasn't pumped as much pre-market or like pre-IPO, which isn't a good sign for this one, but I suppose I could take it short. I don't know. rallied into close. I got stopped on that put. So took profits on the first one, break even on the second one. All I need. When it's in such a small range and so choppy, it's to be able to come out green is plenty. Now if we can get this reversal, that could be a bigger trade today. Given that I missed most of this, just caught that little bit there. Catch this bit? I can't remember. I'm gonna start scaling back into calls now. Nice and easy. Got a nice RSI divergence here on the 5-minute if this holds. MACD's flipped on the 5-minute. Nice, GME, but well done. Apartment inspections. Oh. Is you're selling your apartment? Yeah, that's the problem with buying options in the morning on SPY, like, or anything. You're just paying for a lot of volatility. Unless you're gonna close it within the first hour, it's like usually you can get a better price. Unless it just rips and keeps going, but even then, just kind of waiting for the IB to settle down after the first couple hours in the morning. Closing those calls. Okay, now it's 11:50. Definitely danger time. Can't help it. Yep. I mean, again, yeah, if like you buy it and it just rips out of the gate and then doesn't come back, but even if it rips out of the gate, usually it'll consolidate and have a retest and a dip, and oftentimes even that price is better than buying it in the first 10-15 minutes. But yeah, can't help it. You can just start small and always scale in. That kind of helps me. You have FOMO, just very small position sizing. So if you're planning on buying 5, you only bought like 1 contract this morning just to clear your FOMO. Then now you can start buying, 2, 3, 4, and you can start scaling in. Or just don't buy in the morning at all unless you plan on selling in the morning. There's that chop.
I'd pretty much be a seller of XLE at these. I would wait for a little bit of a pullback to get started here for the specs to start to pull the plug on their position, but I'd be a seller of XLE.
And you'd be buying Coterra Energy and Nat Gas. And, you know, we were showing Nat Gas and RBOB and heating oil tomorrow. I know you also had some thoughts about the production cuts and whether or not they may be reversed. I'm curious to hear what you think might drive things. And in the bigger picture, as I mentioned, some of the other commodities.
So actually, we're sort of looking at the OPEC production cuts, at least the unilateral part of Saudi with a extra 1 million barrel a day cuts. Those are where we see potential for those to be either reduced or walked back entirely. We sort of view this in the context of more geopolitical lens. So what Saudi Arabia is doing globally in the sports arena and other areas are sort of flexing their muscle, showing that they are a power player. All of this is going on in the context of Saudi Arabia having ongoing discussions with the U.S. on nuclear agreements, security agreements, possible agreements with Israel. And so we think that it would be potentially a great headline for Biden to say that he bought, Saudi Arabia to add this additional 1 million barrels a day to the market. And we see that because Saudi typically hadn't, announced these production cuts for the duration of the year in advance. They were doing that on a month-to-month basis. So the fact that they sort of put that out there for the rest of the year, we sort of view that as a negotiating tactic with the U.S. in the context of they don't want to crater the global economy either.
Yeah. Okay, Tamar, thank you for that. And Bob, just quickly, do you see any M&A action that might happen? What do you think about the administration and refilling those strategic, the barrels, the reserve, the strategic petroleum reserve? Just quickly, I only have about 20 seconds left, Bob.
It's going to be very difficult for the administration to buy those barrels versus $90. It won't happen. The SPRs are beaten down levels, and it's off the table as far as saving the day versus high prices here.
Yeah. All right, I'll type in an Instacart at the same time, getting a price there. Bob Yager of Mizuho, Tamar Essner at Vectus Energy Partners. Thank you both. And of course, we're keeping our eyes on Instacart, grocery delivery, digital marketing. This was a $30 IPO, $10 billion valuation. It's indicating around $42 a share, so it's looking up over 38%. There's still demand. It hasn't opened yet. We got you covered here on Schwab Network. Thank you for being with me. I'm Nicole Petalides. I'll see you at 2 p.m. Eastern Time for the watch list, but keep it right here because Fast Market is next.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free means more. You get commission-free online trades and quality trade executions on our powerful platform. Plus the satisfaction guarantee. Expect more from your firm. Trade up to Schwab, the better place for traders.
Trading the trending names every day. I'm Tom White, host of Fast Market.
Okay, grab some more calls there. We're getting a little confirmation now. Start building this position again. The whole complex just to look at them? Oh, I see. Good advice for that itchiness. Yeah, this is now the STD channel. How to cure your itch.
Not work.
All right. Okay, grab a couple more calls there. Excuse me.
The Fed will offer economic forecast tomorrow, and investors will watch for commentary around the path of inflation and the future of monetary policy.
It's only
Let's
noon.
take a
I
look
got
at
plenty.
the four major indices, which are just off the session lows as we speak. The benchmark S&P 500 down about 0.6%. Dow Jones Industrial Average off over 250 points, or 0.75%. Leading to the downside, the NASDAQ 100 off about 0.8%, and the Russell 2000, the small caps, down about 0.3%. To help me break down this market action, let's bring in my co-host. That's Kevin Hinks. Kevin, we've got some weakness. It seems like over the last couple sessions, starting on Friday. Yesterday was relatively flat. Friday really weak. Couldn't gain any traction yesterday. Today, another weak session. It seems like traders, investors on edge going into the Fed meeting tomorrow.
September is historically one of the more bearish months, and there's not a lot of, there's not a lot of macroeconomic reasons to go higher. There's some micro. I think there's some individual stories that are pretty good. But there's a mix. There's individual stories that aren't very good either. There's some stocks that have been pretty heavy. There's some stocks significantly off some of their highs. I look at some of the industrials that are weak. Boeing has slid, almost touching the $200 level back here. So when I look at these names, Tom, they're waiting for some big event coming up from the Fed tomorrow, and they're not going to get it. I mean, I don't think they're going to get any catastrophic change. So what's the next, as we're getting to the end of third quarter here, what's the next inertia for the market? You know, you got valuations high. You've got a Magnificent Seven that's struggling up at these levels, and they drove us here. So if they fail, the market's going to struggle.
Yeah. And, you know, there's individual names that are down. Disney on their investment in parks and cruises. Starbucks.
So much for cutting expenses at Disney. 60, what is it, 60 billion?
Boy, he's got a job, doesn't he?
Oh, man, trying to right that ship is not easy.
No.
And he's got so many things working against that company. But, that Disney has some issues. I mean, that stock was over $200.
Yeah. Starbucks downgrade today. So there's names out there, as Kevin mentioned, that are kind of driving the market at this point, but weakness across the board. A couple names that did get some positive news today. Let's turn it positive here, Kev, is the cruise lines. We got an upgrade out of CCL and RCL today. Let's bring in Caroline Wood, senior markets correspondent, to help us break down this note. Caroline, you know, I've been watching crude oil go up over the last couple months, and that's typically a headwind for margins for a lot of these cruise lines, but an analyst turning positive on these names.
Certainly seems to be the case, Tom. And yes, the cruise lines have been under pressure so far in September, but getting a lift today. We're seeing shares of Royal Caribbean up about 2%. Carnival has given up the majority of their gains, basically flat right now. Also, Norwegian, which wasn't included in this analyst note, up about 0.7% right now. But yes, this analyst is over at Truist and says it didn't take us a long time to get back on the bull train. Strong forward trends plus cooled off stocks make us again positive on the sector. In turn, upgraded Royal Caribbean to buy from hold, bumped the price target to 137 from 115. So Royal Caribbean currently trading just below $98. So quite a bit of upside there, according to this Truist analyst. Also raised its 2024 earnings expectations to $9.10, all the way up from $7.14, following what he called massive beat and raise earnings reports, and boosted his 2025 earnings estimates of at least $12 versus expectations of $10 that the company had previously
coming back
said.
down.
So
12 o'clock
it says
now.
its view for both years are
We're in the
well
chat.
ahead of expectations. As for how this rating
Gotta
stacks
stop
up
his
to the
calls,
rest of
but
Wall Street, 137
I'll just sit on
isn't the
for now.
highest on the street. JP Morgan has that at 139, but it's the second highest. So pretty bullish for RCL. About 80% of analysts have a buy rating on shares, despite the fact that it's up 98% year to date. That being said, it's still about 13.5% away from 52-week highs. Meanwhile, Truist also upgraded Carnival Cruise Lines, but is less bullish on this name. Upgraded it to hold from sell with a price target of $17. That's only $1 higher than its previous target of $16. And if you take a look, Carnival currently trading around $15 right now. So only about $2 upside from here. The analyst says despite being the relative underperformer in their cruise coverage, frankly, it's difficult to defend a sell rating on Carnival when one thinks rising tides will lift all boats. Also pointing out that Europe is showing the greatest degree of strength for 2024, and says Carnival actually has the most exposure to Europe.
Oh, that's my trigger.
On the other end of the spectrum, it sees a great degree of new competition coming to Carnival from industry disruptor MSC Cruises. So that could be keeping shares in check. The majority of analysts are also bullish on Carnival, as opposed to this Truist analyst who's just basically cautious. There are 11 buy ratings, 5 holds, and 3 sells, but the median price target for Carnival is $17, so in line with this Truist analyst. And like I said, only about $2 higher than where it's currently trading.
So, Caroline, the
Now
great thing about the cruises in terms of the health of their company, health of their sector, health of their stocks is they have what every company needs, right? And that is demand for their products. People miss them that weren't on cruise. Now, I've heard you come on this network and go on record as being not a fan of the cruise line industry. And I can just tell you this, as someone who is a fan and just got back from a cruise, I can tell you, come on the kind of cruise that I go on, Caroline, and that will change your mind.
Well, as long as it's not the poker cruise that Oliver was talking about, because I couldn't think of two things I'd like less. But I've always said maybe an Alaskan cruise that actually appeals to me. But yeah, no, I'm not going to be jumping on any cruise boats anytime soon. But it is, as you said, the people who love cruising, and they're continuing to do it. So the demand has been very strong. And I was talking about this with Oliver earlier this morning too. It is, I don't know, Kev, I'm assuming you probably go on the fancier cruises, but there are ways of it being cost effective, especially for bigger families and such. So I think that at a time when people still are very much spending on services versus goods, still very much want to travel, but have been pressured by, inflation across all levels, really, seems like it could be a good, more affordable option for travel. So to continue with the travels, but do it at a bit cheaper of a cost, and you pay up front, right? So once you pay and you get on the boat, it's like, oh yeah, this is free. Not quite, but there's psychology around that, and I've heard the executives on some of these earnings calls talk about that. So I think all of those things,
It's a 10 Queen would beat me.
play into some bullishness for cruises, but as Tom made reference to, those oil prices certainly can't help. So in the
These
next
guys are gonna
reporting
have a
season,
queen.
let's see what some of these cruise lines say about the headwind from oil prices.
Gutsy move to
Jack
upgrade them
queen.
in this environment.
have anything.
With the headwinds from that. But Caroline, I'm in your boat.
Eyes flushing
I'm
down.
not taking a cruise anytime soon.
Just
but
come on the cruise that I go on, Caroline.
First hand.
There's a new cruise line out there. Ritz-Carlton
First hand
launched a
just
couple
tripled
boats.
up.
Check it out.
That's
Looks
what's
pretty
up.
impressive. All right.
All right, as long as you guys are paying.
Yeah, that's right. All right, thanks to Caroline Wood, Senior Markets Correspondent here, breaking down the upgrades in the cruise lines. But now let's bring in Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. Randy, I wanted to kind of get your take here. It seems like everybody's on edge here going into this Fed meeting. But as Kevin mentioned, we're not expecting any fireworks, but we get the dot plot, we get some projections moving forward from the Fed. Is it maybe hawkish sentiment that might come out of the Fed and Fed Chair Powell tomorrow that's kind of got the markets uneasy at this point?
It almost has to be. I can't imagine. I mean, literally no one on the planet is expecting a rate hike today. Or tomorrow. So I just don't think there's any way that that's going to happen. So what would cause people to be on edge? It has to be concerns about the press conference after the fact and that he's going to be a little bit hawkish, but I don't think he is. I think he's going to say the same thing he's said a million times before. Look, we might be done hiking, we might not. We're going to let the data determine. We're going to be data dependent. If we have to do another hike, we will. Look, for a long time, I think the markets have been expecting one more quarter point hike sometime between now and the end of the year. I think we know that's not going to come this week, but there's a November meeting and a December meeting. And if either of those meetings results in a quarter point hike, the markets are going to be fine with that. That's exactly what we're expecting. Now, there is some concern perhaps at the end of next week when we get the PCE, if we see an uptick there, that'll be 2 consecutive upticks in
It's kind of, I
CPI
think it's
and PPI, and then
the
also
trend
in
channel we both
PCE
showing
that we may get some more rate
one
hikes.
standard
Why people
deviation.
would be on edge today, frankly, I don't know. It doesn't make a lot of sense to me, and the market's not particularly overheated at this moment.
I kind of like drawing my own,
in my mind, unless it's
but
because of oil prices, as you were just talking about.
there's a lot of chop and it's hard to see. I think
it's been pounding the table on.
It's a good way to do it. It doesn't necessarily mean
reversing.
not necessarily the support and
17%,
resistance
I think,
though.
oil
That
prices over the last
it is a
couple
standard
months.
deviation.
Kevin, but another area that might be causing some pain for this market is going to be yields. I mean, the 10-year yield hit the highest
paper
level
trade
that
the
we
FOMO
haven't seen
suggestions?
since November of 2007.
Oh, on this show?
Earlier in the session.
I don't know if they're FOMO or
on that
crap.
10-year.
I don't know if the
That's
FOMO
gotta be
ones are like.
causing, some pain here for.
I mean, just
these are at
the
least
trades they
causing some
play out.
headwinds.
Well, as you know,
I've done some of the
bonds
trades
and notes get to this level,
that
they
they've
become
mentioned.
an attractive
I've liked them.
alternative to
Done them.
stocks. And so
But
when
you're
you
talking about
see
Jenny
them
Shell?
get to this level, and knowing that you can lock in a
Do they give
4.3%
option
for
plays
the
on
next
those, or
10
they just
years,
talk about
for
the stock?
some
I can't
people,
remember.
especially elderly or net savers, that becomes fairly
I'd
attractive.
paper trade it. That'd be
And with
interesting. We
where
can start doing
bonds
that.
have been, bonds and
I don't have
notes
anything
have
on
been
my
for the
paper trade
last
account right now.
several years, this looks like, you fell down the stairs
We do
into
it.
a big pile of Christmas
It's a
with
Charles
yields
Schwab
up at
Network
these levels.
paper
So
account.
I think it's attracting some people, and
Copy every one of their plays.
this has been a great rally for stocks, but it's been very narrow.
Right.
In the fact, and you mentioned a couple of names going through some staples in the S&P 500. Yes.
Brand names that are just getting pummeled.
Disney and Starbucks.
Nike.
Right.
Not a bad idea,
there
Kitty.
are some companies struggling here. So when you look at these are a less risky alternative to stocks, and there's competition for yields right now, Tom. There was no competition for years and years and years. Now there clearly is.
Yeah, that's definitely, the risk on trade maybe losing a little bit of its luster here going into the latter part of 2023, Randy. But when you look at some of the commentary that might be coming out of the Fed tomorrow, Randy, I know we want to focus on that, is expectations. And, the dot plot's going to come out. Last dot plot that they released, it seemed like every member was above where the terminal rate was going to be. Now they say that might be parsed down a little bit. Atlanta Fed GDP now just came out 4.9%, I believe, so it's weaker than it had been, but still elevated at this point. So there's a lot of different things, kind of playing against each other in this market going into commentary from the Fed.
Yeah, it's funny. I don't think anybody takes the Atlanta Fed GDP seriously, right? It's come down, but from really a 5% level when probably the consensus out there is around 2 to 2.25.
Is a flush.
Crazy, and I know it's a real-time thing, but honestly, we're only about what,
Okay,
4
might.
weeks away from getting that number. The dot plot's always funny too, because the Fed says don't pay attention to the dot plot, but then they publish the dot plot. Of course, everybody pays attention to it. If it was irrelevant, why would you even give it to us? So that doesn't make a whole lot of sense either. Again, you're right.
Nice.
I think you're
Have a
right
flush.
about the yields. I think that's an issue. It has been an issue for a while. It's also one of the reasons why, as Kevin was saying earlier, we've had some pretty narrow participation in this market. And certainly prior to the debt ceiling deal back in June, we did have only the mega cap 7 that was
one play on
performing.
FOMO.
Since then, the breadth has, things get a little tenuous. As you said, when yields
That's their
start going a
Palantir.
little
That's true.
higher,
They're always
people
doing
need a
Tesla.
place to put their money safely. And if it's not in fixed
Yeah, we
income,
could just
I know
paper
they're
trade the
putting
FOMO
some of it
section.
there, but they're non-fixed income money. They're likely going to hide out in these big giant companies that have big strong balance sheets. Now, unfortunately, a lot of them aren't really performing all that well right now. They had been performing well up to this point, but some of them, like Apple and a few others, look like they've topped out a bit, at least in the near term. So I'm kind of with Kevin in what he said earlier, in that I don't see what the next catalyst is to drive markets a lot higher. My belief from here on out for the rest of this year is that we're probably going to get maybe 3, 4, 5% over the course of the next 3.5 months, which should put the S&P 500 right up around its all-time high. But the easy money for the year seems to have already been baked in at this point, and it's going to be a rough, sort of choppy slog, I think, from here on out.
Definitely. Kevin, when you look at those projections moving out, a lot of people are expecting rate cuts, by the middle of next year.
There could be the bearish
because the Fed's told you, right? If you look at consumer inflation expectations, even out of that University of Michigan number, last year, the 1-year rate's above the 2% that the Fed wants, right? The 5-year rate, 2.9%, that's still above 2%. What makes everybody, I know you want to be optimistic. I know traders and investors want to be optimistic. But if the Fed's telling you they're not cutting and everything points to them being still above 2% next year,
slowly scaling back into calls
have
again.
Those expectations, unless something breaks. I think that's the key.
There it is. The probabilities, right? We always play probabilities.
Could have just held through that, not got stopped out, but
is going to probably
breaking through support.
Not well scare the market, but jostle the market a bit, as if those projections go higher or remain high for longer. Now, we don't see any rate decreases coming in the near future, but always a low probability, something not on the calendar, some event could happen that would cause rates to go lower. That's always out there. It always has been, always will be. There's always some risk that some event could happen, and it comes out of nowhere. So there's always, the risk the risk of
something
recession or something like that. There's always something out there. But yeah, I mean, I think the dot plot, even though Randy's accurate, Jerome Powell says, don't put much faith in the dot plot. It's a snapshot of what they feel right now, and that could change, which I agree with. Yeah. But it's still, it's still something the market will pay attention to tomorrow.
Burns is halted?
I'm wagering on the phrase data dependent tomorrow a bunch of times during his commentary.
Safe bet.
He will say it.
He will say it multiple times. All
It's
right, guys.
Weird to see a penny stock halted like that.
Look at NVIDIA. Chipmakers
Must be on
rallied
news.
on the back of its AI chip, about 195% so far this year. But we've seen some recent weakness in this name. Fast Markets coming right back.
Oh yeah, what about cart? Up a little bit. Still middle of the day chop. Gotta be wary. Weary? Or wary? different words, aren't they?
Weary.
Wary.
Wary.
Wary, yeah. Yeah, wary is the word. Weary is like tired. Weary is a feeling or showing tiredness, especially as a result of excessive exertion or lack of sleep. That's interesting. I don't feel like that word's used properly that often. And then wary, feeling or showing caution about possible dangers or problems. Be wary of the wary. Yes, this is the way. No. Be wary of the weary. You did it wrong. Or no, I read it wrong. Be wary of the weary. Yes. Did it right. Good job, kitty. My birds is halted. I don't know if there's any aces out there, maybe. Wary of the weary. The hairy berry. Or worry won't weary. That it?
Currently 104. So it is still stretched. There's other stocks that are stretched too. ARM Holdings. If you think this is expensive, you should see ARM Holdings. But actually,
There's a couple clubs out there.
If the growth rate can continue,
right,
then you can make a case, a bull case for this stock. But it's got to continue.
Yeah,
those numbers are lofty.
I think that's been a concern for investors out there, is what valuation makes sense for this, because the growth rates can't keep going the way that they are.
Right now, it's outpacing the price of the stock, which is hard to imagine.
Yeah.
How long can that go?
Yeah, well, valuation actually came in because of those past couple quarters. But Randy, when you look at this and you look at a stock that's rallied that much, is it justified at these levels? The price to sales, Kevin mentioned, really elevated compared to historicals. But do historicals matter when you're talking about a stock that's innovated or a company that's innovated so well, and they're the leader in this space and they've got market share?
Well, I think everything you said is right, and you're right. How do you value a company like this? I mean, NVIDIA has become synonymous with AI, and as you said, they're not just the leader, they're kind of the only game in town. But as you said, the valuations are kind of astronomical, and this is kind of part of one of the companies that ignited this AI rally that we had starting in the summer. And it's up a huge amount, but it's down about $70 in just the last 3 to 4 weeks or so. So this one is volatile. It's all over the place. The markets are a little shaky, not right now because of all the reasons that we were talking about a few moments ago. But if the markets take off again, because this is one of the mega cap 7 that we've also been talking about, odds are good when people get happy in the market, whenever or if ever that happens, this one will be part of the leadership that pushes things higher again. but it is volatile. It's difficult. Picking an ultimate direction is really, really difficult in the short term. In the long term, I think you could probably argue that if AI materializes as everyone expects, maybe there's opportunity.
Oh, he had the straight. No way.
For a very short term, man,
you
can
nothing.
get crushed in something like this if you're not careful. So
Got
it's
on the
tough
river.
to figure out which direction you want to go. So you probably, if you're going to trade it,
What
need
about
to come
smaller?
up with something that's
Not bad enough to
pretty
get him to
short
fold.
term and has maybe, you know,
Aggressive.
a theory that
Must
that
bear
will
the
not
burden
hurt
of
you
the
too
weary,
bad if
weary
it goes
bear,
against you.
bar bears.
And you look at that, you mentioned the volatility of the moves
Must
in
bear
this
the
name.
burden
Beta of
of
about
the weary
1.8, so S&P 500 beta
Berry.
of 1, so it's nearly double
Bar bears.
the amount on a percentage basis as far as moves go in the stocks. But Randy, you know, it seems like premiums.
1.8 seems low, doesn't it?
I was
weird. It seems
when
low.
I looked at it, I was expecting to see 3.5 or something like that. But Randy, looking at this from an example trade perspective, how do you want to you cover this one?
Yeah, so again, we can always go a lot of different ways, and with one like this where you're going to have a huge divergence of opinions, as I said, clearly some people are going to say it's way overpriced. Others are going to say, yeah, but
I can slow play
this
it.
is
Usually
the most important name out
bites
there.
me because no one
You
folds.
can go a lot of different directions on this. What I thought I would do for an example, again, not a personal opinion on this one, is let's do a relatively short-term trade. If you keep it short, you've got less potential movement, even in a volatile market
kicker.
like we're in right now. So I just looked out to the end of this week.
Spades got there too.
Let's do a thing where we expect it to stay.
Just check
it's
this
gonna
one
be
through.
A little volatile. We think that's probably true, but we expect it to stay within a reasonable range over the next few days. It's always easier to predict where a stock will go over, say, 3 days than it is over 3 weeks. So
Slow
just
play
look out
worked.
to the end of this week.
Thought he might have something.
Let's say we think it's going to stay in a relatively tight range, although with a stock
Bear,
this expensive,
bear.
that range can be pretty wide. In this case, it's 40 points. So I put together
Bear a word?
an
It's not
iron
just
condor.
a brand?
We're going to buy the September 22nd 395 put. We're going to sell the 435 put. So again, it's 40 points out.
Yeah, that's just
then we're going to sell the 435 call, of course,
company
and then
or
buy
name.
the 475 call. And this could be done a few
Oh, like
minutes
this
ago
one, we
at
could
about
paper trade this
13.50
one.
credit.
We'll just do FOMO
You've
though. I
got
like
a
that.
max
It's fine.
gain of the amount you bring in, so that's
Or we could do all of them.
$1,350 on a one lot.
Have all these
But
ongoing
because
trades.
it's 40 points wide, that leaves you with 2,650, or just about double that amount.
These
as
trades are so
potential
complex
risk
to set up. It's like
but this puts your break evens at
have
about
to pause it.
421.50 and 448.50. In other words, you're expecting over the next 3 days for this to stay in that range. And your maximum gain would be if the stock is essentially pretty close to where it's at right now, right at that middle strike of 435.
Yeah, let's break this one down. This is Kevin Big Boy, a short iron condor. Sometimes we refer to this as an iron butterfly because he's selling the same call and put strike, the 435. So let's break this one down. Selling a $40 wide call vertical, the 435, 475. And then on the put side, selling the 435 put, buying the 395 put. $40 wide on each side, collecting roughly about a $13.50 credit. It might be a little bit higher than that. But if you collect $13.50, Randy mentioned those break evens just below 422 and just above 448, Kevin, on this one. But I think when you look at this one, you go, oh, but you've got that 2650 in risk on this. But at the same time, you've only got 3 days till expiration, so duration short.
3.5 days. So the theta on this is on a one lot is about $128 a day. Now that's theoretical. You can't put a pen to paper on that, but that's pretty chunky. And you're right.
Inverse mortgages.
This has risk. The margin on it is
much.
the width of those spreads, which is $4,000 on a one lot. But you need to move, and you need to move fast, right? And you do have about $13.5 on either side
without the trades.
where you're still
Yeah,
profitable
but yeah, we
in
can
that
find out.
range. So you could have a $10 move.
You were saying just a FOMO
in the
segment. What
next
about
3
all
days
these?
and still be profitable on this trade. Now, a catastrophic move, there is risk. You've got two $40 spreads in either direction, and so there is risk on this trade. Make sure you understand that the risk is the difference between the width of the strikes, $40, minus the $13.50, $13.60 that you bring in.
I know
so
that it's crazy. They do like really short-term options too.
And it's time, and it makes money
For
while you're
term and
sleeping
18
at night.
different legs on it.
You know, this is just one of those great
Birds must be halted on news, right?
trades that is great to learn from. You don't have to do $40 spreads. You could do 5 or 10. But you know, this is a great example of what you can do with options based on your opinion.
Yeah, and you got to make sure you're, you're taking that neutral, basically, stance on this one. Maybe the stock can grind up a little bit more on this one. You've got some assignment risk if the stock settles between those short options on there on the 435 on the put or the call. So you got to keep that in mind also. But this is one of those strategies, Kev, when you look at it, that, hey, maybe if it goes down in a couple days, it's still in that range. It goes down to maybe $8, $7, $5, $6 or something debit. Maybe you close a portion out if you do multiple contracts on it, if the market's open, liquidity is provided. But a good look at a short iron condor or short iron butterfly, as we call it, sometimes as an example trade here.
Let me correct myself too. You're right. It is a short iron butterfly. I misspoke when I said condor earlier. You're absolutely right.
Yeah, even on the platforms, it's listed
sometimes it lists it as a condor.
Iron condor. So we're good there. And thanks to Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, breaking down markets and NVIDIA example trades. But coming up after the break, Kevin and I are going to be joined by Megan Brantley from Likefolio for discussion on General Mills and the data on the stock moves. The consumer staple stock has fallen about 27% since hitting an all-time high in May. Reports earnings tomorrow morning. Nobody's eating cereal, I guess. Coming right back.
Fast market? Yeah, maybe. They don't always do weeklies. But yeah, usually they're like within a month. In the monthly. I mean, it looks like a bear flag heavy. Re-raise, come on. Oh, I didn't mean to bet 20. Whoops. Thinking about bluffing, but someone's too many people here. Ace high is nice and everything, but too eight.
Because it seems like they're seeing some price pressures, but maybe, inflationary pressures. What kind of data do you guys have?
Yeah, I love that we're talking about General Mills today, because last time I was in Target, I saw the, Count Chocula and Boo Berry and Monster Mash cereals all on the end caps. And this is really, I think, what General Mills is most known for, but it really has a wide portfolio, right? It's got, those cereals, the Cheerios that you think about, but it also has some, baking staples if you think of like Bisquick, if you think of snacks like Bugles. And then it's also now got a pet food segment, and really that's driven by the Blue Buffalo brand. And so there's a lot to break down in our data when we look at General Mills. And what we see, I think, is not necessarily surprising. Whenever we're looking at the largest brands, so the mentions that are getting the greatest amount of volume, you think about Cheerios, these cereal brands, it's Betty Crocker brand, and then also Blue Buffalo. And we do see a little bit of shifting, especially in its Blue Buffalo, which is a premium brand. And this chart here, I think, is really significant because you can see the bar on the right in these pairs. So it looks almost like the brighter blue bar, the darker blue bar. That is the growth in premium pet food versus non-premium. And you can see a shift that occurs at the end of 2021 or 2022 where we're starting to see signs of consumers who are trading down. And so this could potentially be a negative, headwind for Blue Buffalo that's operating as this premium brand. When we look at this on a brand level, we have Blue Buffalo buzz and demand up by about 2% year over year. So not horrible, but not the growth that we were seeing, especially after the pandemic when we saw so many consumers who were, buying a new pet that all of a sudden they had another mouth to feed. But I think that, long term, this is still a brand with really high happiness. And I think it's smart of General Mills to diversify its revenue streams and really lean into this pet segment, especially as pets become more humanized, as part of our family. But just near term, we are starting to see a softening in that growth as consumers' wallets get pinched a bit.
Oh, gee, my turn. Sorry, Megan. So I was watching. I was thinking about Chex Mix, Megan. That's what distracted me because, I look at this company and, it looks like they've just been squeezed on their margins, right? I mean, their organic sales up 10%, but their gross margins down 110 basis points.
Oh my
this
gosh,
is just
got
one of
there
those companies going through what they've been through many times in their 100+ year
you have
history,
that on the flop?
which is higher prices. They make a little less money. They know the game plan going into this. They just raised the dividend an enormous
I don't think he had that on the flop.
Now their dividend is almost 3.6%. Not that that's guaranteed, of course, as you know. But Megan, isn't this just one of those situations where
investees
inflation will eventually dissipate?
Talking about how to get rid of the itch earlier.
This company that has massive popular products
Super
will
Brahata.
simply just hunker down, get through this, and this is probably a good opportunity to look at a name like this.
It definitely could be, especially if you're looking at a really, long-term horizon in a name like this. We're talking about serious consumer staples. I mean, Cheerios, it doesn't get much more classic than that. I think that the company's also doing a good job of leaning into some consumer trends. When we look at the brands that are kind of popping, at least in terms of our positive consumer sentiment, you think about it's Annie's brand, which is like healthier versions of box mac and cheese and
He's going with a high card,
if you will. And you think about Lara Bar and you think about Nature Valley. So it has things other than just Cheerios that consumers are really latching on to. And I think the pet food segment, as I mentioned before, that's another really important area. Whenever we look at, mentions as a whole, we see some softness in General Mills. So we're not necessarily surprised by this decline. I think mentions overall are down by about 6% year over year. But if you look at that, the stock has fallen by much more. So this isn't a scenario where, we're bearish. This is just something where we're seeing a slowdown in some of this growth, and it could be a good opportunity for long-term investors for sure.
Megan, when you look at happiness levels compared to its competitors, do you guys have any data on that? Because it seems like the wide array of products that they have, I get that maybe you're seeing a pullback in some of the premium brands due to inflationary pressures from the consumer. But happiness levels, are they comparable to some of their competitors with all these brands they have?
Yeah, so one company that we like to look at in comparison to General Mills is Kellogg. And just from a mention perspective, I mentioned that General Mills mentions have dropped by 6%. Well, Kellogg's mentions have dropped by about 36% year over year. So they're definitely, outperforming peers in terms of overall consumer buzz. But then whenever we look at those happiness levels, they're outperforming there as well. So General Mills happiness is around 69% positive. I think Kellogg's is around 67% positive. So 2-point difference, not massive, but
Good
General
morning,
Mills
and
is definitely
Mariah.
on top. And part of that, like you said, is because of its diverse array of portfolios. You know, we see a lot of people who are really excited about the healthy
Maybe a
foods,
double
but
bottom
we
there on
also
SPY.
see a
We'll
lot
see.
of people who are really excited about their Cinnamon Toast Crunch.
I like Cinnamon Toast Crunch.
That's right. And Golden
Frosted
Grams.
mini wheats.
You did mention Chex Mix, dear.
I love Chex
I
Mix.
do too.
Golden Grams. I haven't had Golden Grams in a long time.
Nature Valley. Who doesn't like their granola bars from Nature Valley?
That's
Come
old.
on.
I don't.
That's old school Nature
know.
Valley right there. All right, great stuff. Great day as always, Megan. Appreciate it.
Thanks, guys.
All right, that's Megan Brantley, Vice President of Research at Likefolio, breaking down the consumer sentiment data here on General Mills. Kevin, you look at the right side of that chart over the last 4 months.
Ugly.
It is ugly. It was over $90 a share. Now trading down near $65 a share. That's a pretty big sell-off.
Yes,
yeah, look at that.
Right around mid-May.
That was all-time highs.
Yeah, mid-May it would trade up to $90.89 and just.
Do you remember during 2022, everybody kind of piled into staples?
Sure.
That was their safety play. They were selling tech. But General Mills and a lot of these consumer staple names, Procter & Gamble, Colgate, CL, and some of the others, they were able to raise prices. They're inflationary. They felt inflation, but they were able to raise prices across the board every single quarter. And now we're starting to see the lag effect of inflation taking hold because their margins are starting to shrink a little bit. Organic growth not growing as robust.
I mean, if you look at a 3-year chart, it's down to levels that it traded
I watched too much Rampage.
in October of 2021.
Yeah.
So middle of the pandemic
New low of the day on
is
SPY.
where it was when last time it traded down around this level. So I kept this really simple, Tom. I mean, I did a covered call strategy. This is a paper money trade. If you were looking at strategies, this is one strategy.
Oh my gosh, I love it.
I look at something like this.
A pair of
The
nines.
fundamentals say it pays a nice dividend that it just raised. Now, dividends aren't guaranteed, so we don't know. But this is a consumer staple with a long history. Like I said, it's been here over 100 years. They have these products that everyone knows and uses. So if you look, Tom, it doesn't have weeklies. That's one thing working against this. But if you buy the underlying, you sell it out of the money call. You know, the 70 calls
That was so aggressive for one pair, one low pair.
About 31 days. It's not a ton of money. You could lower that to the 67.5 call, but that's more at the money. You know, it's only about $1 higher than where it is now. So I bought the underlying on my practice trade, and I sold the October 20th 70 call. And so that package is trading right now about 65.40. It was trading a little higher when we put this in. It's trading about 65.40 now, but it's you're collecting theta. Again, one of the issues here is it doesn't have weeklies. So be careful there. You have to go out a full 30 days. So make sure you don't use the 1-day trade, but use the 31-day trade is almost $4. That's why I didn't go with the 67.5 call. I moved it out to the 70. You collect less money, but that chance of an expected move is almost $4 between now and October expiration. So I wanted to give myself more time for it to get up to that level if it does start to recover. Because the stock has been, as you see, beat up, and it's pretty oversold right now on a weekly level. It's oversold. Yeah, it's just getting out of oversold on a daily level. So it's trading 33, but it was oversold for a while there.
Yeah,
so,
did get below $65 a share a couple weeks ago. As you mentioned, 2-year lows on that. So looking at this example trade Kevin brought us, cover call strategy here, where
when's cart going to come out? It's taking forever.
Selling out of the money call. In this example, Kevin used selling the October 70 calls. We've got 65.70 on there. As Kevin mentioned, it's about 30 cents lower than that. The stock has pulled back. Kevin, you mentioned that dividend if it gets paid out. 3.6% dividend yield.
Not a small number.
Not a small number.
PE around 15. Think about what all the PEs we're talking about on this show today. It's a 15 PE.
Right, exactly. So if you pay $65.70, that's going to be your break even. $65.70 on this one. Now, risk on it is if the stock were to somehow go to zero, you got to mention that, down to $6,570 if the stock were to somehow go down to there. But as you get closer to October expiration over the next 31 days, you do have that ability to roll or adjust that short call if the market's open, liquidity is provided. That'll create more credit. So this type of strategy takes advantage of the dividend yields if it gets paid out, and then also the yield on the short call that you sell against your stock. Even if the stock kind of consolidates here, you're going to be okay because you're collecting credits and creating yield on that short call.
Just remember, every time you sell an option, right, and then you were to buy it back, if it expires worthless, you've lowered the net debit that you pay for the stock, and thus lowering the break even.
Yep, and increasing potential profitability on an example trade like that. So looking for maybe some consolidation, a grind higher here. Option market's pricing in about a $2.60 move either way in the shares post earnings. All right, Kev, let's take a quick break. Come back, we're going to talk ARM Holdings.
Oh, snap.
The chip maker had a successful IPO last week, but the stock's been under pressure since.
This guy Pocket Kings.
We'll take a look at this one. Options just started trading yesterday on this one. Fast Market's coming right back.
10-3. Oh my gosh. I got it with 9 queen. Oh my gosh. I got lucky.
My dad was a hard worker.
You had an awful hand. Why the heck? My hand wasn't even that good. It's better than his though. Gotta play so reckless this table. Excuse me. Excuse me. And try and isolate some of these guys. Run all in. Full folds. Need some more folds. Then I need a 5. Oh my gosh. Okay. I think I beat him. Good, I got him out of there. You have queen 7? Oh, pair of queens? Didn't even have a top pair. they had lowest pair. Or maybe mid pair. Alright, I'm out of those calls. Yikes. Should be inputs right here. Not prepared. Hate getting with the low of the day. Yeah.
Tough one because, yeah, they are profitable. Then you have to consider profitability as trading at a reasonable price based on valuation for ARM Holdings. I mean, look, at the end of the day, there's a reason this was a big IPO. I mean, effectively, this company has 99% of the market share. Nearly every smartphone or tablet-based device out there from a consumer electronics standpoint uses ARM's licensing technology. So their mobile applications market share is immense. They are generating, not too great of sales compared to perhaps the valuation. I think this is, again, some of the concerns that, the value investors have right now. But at the end of the day, the company has been around for a long time. Their design technologies and licensing technologies are ubiquitous. So they're pretty much in every smartphone app out there. Even though Apple uses their own CPUs, they do of course use ARM's licensing technologies.
Ready for the river?
Partnerships with major players like Intel, Google, if you will. AMD also utilizes in some capacity ARM's technology. So this is a company that doesn't manufacture semiconductors per se, but their licensing and technologies are embedded in basically intellectual capital across the board, across the globe, if you will. Now, data on this company is a little bit sparse, but at the end of the day, what I'm going to do is look at it from a valuation standpoint. If you consider what I did here is looking at sales for ARM Holdings in the past 12 months, it's about $2.7 billion. Now, if you compare that to last year, it's actually slightly down, but that's to be expected considering a lot of the other semiconductor names like NVIDIA even on a year-over-year basis showed some declining revenue, particularly in the back half of 22 and the first half of 23. So if you compare that number to 2021's earnings or sales, forgive me there, which was around $2.03 billion, the sales growth in the past 2 years has been about 30%. If you look at NVIDIA, just the sales growth from Q1 of 2023 back to Q1 of 2021 was higher by about 62%.
Neither
That's
met anything.
the last two quarters, by the way, as well. So it's not growing as fast as companies like NVIDIA,
idiots.
but at the same time, they had essentially revenues that were generated,
Nice hand.
like I said,
Nice high card.
$2.7 billion, but they had 31 billion devices in which their technologies were installed and sold into. So that represents about 9 cents per installed unit that they're generating sales. But I think the question here is, from an investing standpoint, is it worth essentially 22 times sales? It doesn't have the sales growth that NVIDIA does, not to mention, again, on a forward basis, it's trading around 144 times forward earnings. So I think valuation is a little bit rich here for ARM Holdings. It's not a growth company, but it is a company that's extremely important from the technological standpoint of embedded processors across multiple application markets.
All right, great stuff. As always, George, got some breaking news here. Thanks to George Tillis. Instacart starts trading here, trading about $41.75 as we speak.
Opened at 42.
Yeah, opened at 42, up about
What the
11
heck?
bucks from that $30
I hate how Webull does
IPO
that.
price that they set last night
All
after the
slow.
close. You see the tick chart there, kind of all over the place. But yeah, this one's going to be definitely watched. Kevin, what would you look for? It's something here, even based on the ARM Holdings IPO where it shot up and then, you get some semblance of, maybe realization
You had nothing but
on a name like this. But this one's pricing very much above its $30 IPO
Look
price.
at sixes.
I think that
down
this
with the full
is
house.
one that's going to run into some competition.
Gosh, these
It's
guys have
got
nothing.
It does Costco, it does Kroger, it does Wegmans. I think
All
it
of
does.
them, yeah.
It's a big company doing good things, but be careful competition in this. A lot of companies doing it themselves, or DoorDash is their competition,
Right.
Uber Eats is their competition. So they're not without competition in this space.
Yeah, watch that CEO and some of the commentary from her, because she really focuses on the advertising side of their business. That's high margin business. That's why I think a lot of people are liking this IPO. But this is definitely going to be one to watch here as we get through the session today. Watch Instacart trading just under $42 a share after that IPO price of $30. Now, Kev, let's get back to the example trade that we've got here in Arm Holdings. That's the other IPO that debuted last Thursday. So I looked at this.
I'll wait for the calls again.
Have weekly options yet. The option market, there's not a lot of open interest in it yet because it just started trading yesterday on the options.
Having a good day, though, in terms of options.
Freaking
37,000 options have traded. That's a good number.
Yep. And the stock was down earlier about 6%, now down about 4% on the session here. So I looked at something that takes advantage of maybe a differential in implied volatility, but also gives me durations, Kev. So I looked at a call diagonal in here where I went out to the December monthly cycle. They only have monthly options. Buying the 55 strike call, that's basically at the money at this point, just slightly in the money. Buying the 55 strike call, and then in the October monthlies that expire on October 20th, selling the 62.5 strike call. So $7.50 wide call diagonal to the upside. Paid roughly about a 460 debit. It's trading a little bit higher because the stock has reversed a little bit. But if you pay about a 460 debit on that one, that's going to be your risk, Kev, $460 per spread. Break even around that 55 level. Kev, give me your take here on this, where you're giving yourself 3 months on your long option that has a higher delta.
Yeah, you can spend $5,500 on the stock, or you can do this diagonal for less than $500, Tom. And there's the beauty. There's no dividend yet. There's no reason to have the stock when, if you're proficient in options and know how to trade options, this is one that gives you about 31 deltas on the upside. It's collecting theta. It's in the calendar spread family. You've got plenty of vega here if implied vol were to go up, but buying the D's 55, selling the October 62.5, no weeklies.
Yeah, and I did mention that the price is on that. It's about $470, $460, anywhere around there, just below $5 for that. And because it's a $7.50
oh
wide,
my gosh, I just folded quads.
You've got no other break even above that initial break even around 55 as you get closer October expiration. They'll probably add weeklies on this one, so you might be able to adjust.
There's too much volume for them not to add weeklies.
Lots of volume already, only 2 days in.
Man, that would have been a three-way all in.
That one. So good
That'd
look
been
at
huge.
It's a bullish play, but you've got some opportunities to roll or adjust if the market's open. Liquidity is provided on that one. Your risk is what you pay, the debit on that one. And Instacart, still trading, Kev. We'll continue to watch that one throughout the day.
That was a huge raise for a 4-5 for me.
Us here today on Fast Market, but stick around right here on the Schwab Network. Next Gen Investing is coming up.
That was weird. Like Java just crashed or something. Flash or whatever this is. Three queens there, dang it. The threes. Free trip, 3 threes. Does he have pocket tens? Queen 9? He was raising like that with a Queen 9? What the heck? So ridiculous. Alright, I think I'm tilting, watch. Man, this IPO is awful. I don't know why they said the float was like 2 million. It's 22 million. Yeah, they bumped this one up too much. Has been climbing up here. Got back into my calls pretty shortly after there. Just broke through this level, which it always does. Always has false breaks through supports and resistance. Birds is still halted, so there must be news on that.
Said the combined business that will handle all these deliveries will go into effect June of 2024. They're also targeting around $1.8 billion in cost reductions and this improved efficiency by 2024. So they do have then some big shoes to fill that they've set forth by themselves, really. We did see that in June shares slip below their 50-day moving average after they reported their third straight quarter of declining earnings and revenue. Just to paint a picture of that, their fourth quarter earnings fell 28%, revenue slid 10%. They did guide for earnings for their full year that were at the midpoint of the guidance, calling for around $16.50 to $18.50 a share. Street had been expecting around $18.33 a share, so they completely missed the mark as far as the middle range of that goes. But for the full year, they did see adjusted earnings fall 27%.
Yeah, I picked up some shares.
But they did outline a plan to see that improve by 2025. So it does seem like it will be a little bit more of a long-term wait-and-see story.
Those be day trade, probably just a VWAP.
This name does have 19 buys among analysts, 13 holds, and no sells as far as I could see. So while we have seen some strength in FedEx, we'll obviously have to see if their first quarter results can match some of this outperformance, Alex.
I love that you brought up UPS because, Jenny, I think of these two names, there couldn't be two more similar companies, yet the stock prices aren't as correlated as you might think. UPS had dominated FedEx for years prior.
Market cap?
It's struggling while FedEx tries to catch up and regain that ground.
Of course,
UPS a lot more domestically focused than FedEx, which has a little bit more of an international presence. You look at this, though, one thing that's been impressive, if they were to meet the expectations and sort of where their guidance are, is they've actually maintained cost pressures okay at FedEx. They've been able to pass that on largely. Revenue hasn't really grown. They're expecting a little bit of a boost possibly from the Yellow bankruptcy, but for the most part, it's been more of an earnings story for FedEx. They've been able to really increase margins, so we'll see if that story continues. I'm excited for this particular report because it gives us a little bit of a look into how the consumer's faring on an e-commerce standpoint in shipping. But all things considered, still a story that, as you said, is sort of a wait and see, and we'll see where things go in the next few years.
Right, and obviously seeing a pullback today down about 1% here. But our next name is actually our worst performer of the four today. That is Deere, which is down over 7% this year. Now, Evercore ISI did downgrade shares to inline from outperform with a price target that was reduced to $424, down from $456. And the analyst says that feedback from the firm's component contacts over the weekend highlighted some revenue risk across agricultural that is already here for 2023. This analyst noted that farm equipment production schedules are going down for Europe and now also Brazil, saying that production is moving back in line with retail demand in 2024, with retail demand down modestly, thus creating a stronger year-over-year cut in production to justify some of this overall retail softness. So this name has been somewhat of a disappointment, although it doesn't
like
necessarily
3 or 4
huge conviction. It is down about 11% off of its highs. It's still up around
21%
from its lows. But all in all, this name
and then I've seen like just as many that have broken through multi-year supports
based on the average price target of around $454 a share. but Deere has just been lackluster this year, and I have to think that it's tied to some of the overall volatility we've seen in the commodity market.
I think that's exactly right, because while this is an industrial machinery-like company, it even has a little bit of a financing arm for those machines. So tied to the particularly the agricultural products in that commodity space. How are farmers doing? Because if farmers are doing well, they're more likely to spend money on big machinery. Times are tough, they're not going to spend. So it's really that, elementary at times to really think about this company.
Elementary, Dale Watson.
That had been relatively robust, but has been under pressure recently. So we'll see where things shape up. Not the most optimistic note that we've ever heard from Evercore, but we've certainly heard worse. Let's talk some Darden restaurants. So it's lunchtime. Olive Garden, I think Longhorn Steakhouse. Olive Garden's really the cream of the crop here when it comes to Darden.
So fun fact about Darden, because I was digging into all of their various brands, because they have Olive Garden, Longhorn, Yard House, and Ruth's Chris Steakhouse. Olive Garden does account for nearly half of their overall total revenue, though. So Olive Garden is the most important name, no doubt about it. Prior to the pandemic, the New York, basically in Times Square, the New York Olive Garden was the most profitable restaurant in the country among these fast casual, among the tier in which it operates. But isn't that wild to me? I mean, they were churning out like $15 million a year just at that location, and the pandemic absolutely crushed that stellar sales performance we saw from that location. So
people like familiarity.
It is, no pun intended, their bread and butter, but we have seen some weakness in this name.
See if Cart can hold this kind of right shoulder here on the inverse head and shoulders.
This does come despite some 3 quarters of bottom line and top line growth, actually. Sellers hit Darden pretty hard, though, on June 22nd when the company last reported earnings, despite the fact that, again, earnings and revenue did top expectations. Combined same-store sales increased almost 12%, helped by the rebound in their fine dining business. But the company did give a pretty mixed forecast now for the remainder of this year. Darden now is forecasting full-year revenue between around $10.2 and $10.4 billion, with the midpoint of guidance just above consensus at that time. Now, this is now, when they report their earnings, that's Thursday morning. This is the new CEO's second report with the company, so relatively new leadership. But all in all, this name is still up, I mean, a modest 7% this year, despite the recent pullback I mentioned.
So you mentioned, I think you said Times Square is the most profitable Olive Garden. Does that surprise you? I get that there's other places you could go in New York that may be more unique to New York.
But any restaurant of that tier.
Have you been to Times Square? Can you even move there? I mean, is there anywhere else on planet Earth that is that packed at every hour of the day? Makes sense to me. But pre-earnings look alongside FedEx, I think these are clearly the two that we take a look at in the next segment.
I know we say that we're earnings light, but we do still have earnings previews to look at here. We'll be breaking down the technicals as well as some example trades in both Darden as well as FedEx coming up next.
Closing one of these calls here. This resistance. Could see another retest and then, or at least another pullback for some support before we keep going. Art looking for support there.
what the bears are looking for is a new area of consolidation to form at a lower level. As I take a step back from this 30-minute candle chart, a little bit of a different pattern playing out here, but this speaks to how the recent weakness is not necessarily what the bulls wanted to see. This chart goes back to the end of last year, beginning of this year, back in January, where we saw areas of value in this instance actually forming at higher and higher levels. But Jenny, we were just talking about a trend to the downside here on the 15-minute candle chart. This is a daily chart, so a little bit of a longer term, but you can see each one of these areas that formed on the way up never really retraced or took out the area prior to on the way higher. Now, as we were balancing around 266, though, we were referencing the
Cart moving up a little bit here. Got VWAP at 40.87.
Price decay that's ensued since. So some of this recent weakness, again, as mentioned, not necessarily what the bulls wanted to see on that short-term 15-minute time frame, and again, looking like we might be rolling over here on this longer-term daily chart here. Take one more step back here, though. This kind of speaks to some of the strength over the weekly candle chart here in the longer term. This goes all the way back to, we're talking 2000, and some of the strength that we've seen in FedEx longer term, still holding above 200, which I think is key. Potential for a bit of a head and shoulders pattern to form here, which is not, again, what the bulls want to see, but a little bit of a different scenario here, a different narrative, depending on which time frame you're looking at, whether it be that more intermediate, the daily, or in this case, the weekly is still showing signs of strength. The other two kind of showing some weakness.
Yeah, and as you can see, I mean, this name took a nosedive and then has recovered very sharply, and I have to efforts to sort of restructure and reimagine have boosted this name. But in terms of price activity that you're watching here,
like
bigger picture in FedEx,
30% of
jumping
VWAP
out to you overall? Because obviously we can see from this longer term picture that things relatively look strong, but it's been choppy to get here.
Yeah, well, what stands out here is, again, a potential head and shoulders pattern that's forming here with the upper extreme around 320. We just had a lower high, which failed. If we start to roll over now, still holding above 200, which is the middle of this range. We've been in price activity relatively contained. If you take a look here, basically for the last 9 years, I mean, again, you've got a pandemic low down around 8,100, that recent spike up that we just noted around 300 from a couple years ago, and here we are again, still holding above the middle of the range. So this is still
climbing up
very
here.
bullish, but you can see the weakness, the cracks in the dam in terms of that shorter term chart.
Oh,
And be
little
prepared
pop
for that,
bounce
obviously,
by.
with this earnings event, I'm sure that will cause some volatility in shares. But now in trading this name, Alex, walk us through what you're thinking leading into the fact that, like Ben demonstrated, we just saw a clear uptrend. It hasn't been an easy path to get there for FedEx shares, but all in all, a name that's still outperformed this year.
Yeah, we're going to do some rounding here to make this easy. About a $247 price tag on this stock, with about a $12 market maker move, which of course is just a 1 standard deviation range as suggested by current real-time option prices around this event. What would that target? That would target around 235 to the downside, and that's where this trade centers. You can see it behind us here. Looking at a skewed put butterfly, selling 2 of the 235 strikes, buying 1 of the 237.5, defining the risk by buying a 227.5. It creates an interesting risk profile, as you can see behind me. It's done for a credit, 50 cents. That means it's going to act like a short put vertical if all these options are out of the money. However, as it moves towards 235, you can see it starts to peak out. That's where this thing can really be fun and be interesting, and things can really start working for us. It's a $2.50 wide debit spread would go towards max value, while the credit spread would work towards 0. That's the best case scenario. You keep the 50-cent credit and you get the $2.50 wide debit spread working for you. You can expand to 300. If it goes through that, though, break even down to 232. As we can see here, risk is 450. Basically have that $7.50 wide credit spread net of the 300 that you could make, left with 450. That risk all takes place below, of course, the break even, then maxes out below 227.5, where all these options would be in the money. It's a neutral to bullish strategy with the best case scenario at a slightly lower price at expiration. This all expires on Friday, Jenny. Looking for a slight down move, but would be okay with unchanged or higher.
So pretty much obviously an earnings pure play, and I keep forgetting that we're at the end of September. I was going to say this is
Had a lot of chips.
No, that is obviously this Friday.
Gotta get
so
their
thank
pocket
you for
queens.
pointing out. But now our next name is Darden here, who also has earnings Thursday before
Fives.
open. Darden, which we might as well just call all of
Sixes?
Darden at this point, Ben, because that is over 50%
You
of
had
their
the
revenue.
higher
so
full
brand that is
house. Are you
extremely
kidding
important to
me?
them. And I will say it's lunchtime here, so I could go for like unlimited breadsticks or whatever.
Why didn't my fives get
Ridiculous,
there?
Like, they have
What the heck?
bottomless pasta,
What'd
I
they
believe,
have?
as well. But walk us through what you're seeing from the technical standpoint.
What
here.
happened?
This name's held on to its gains, but ever so slightly.
Yeah, from a technical standpoint, it's looking like that brand hasn't done so well for them. DRI, as you can see, over the last few weeks has come under pressure. We were
Repair
double,
queens and
triple topping
sixes?
up around 158. We saw some consolidation around
Thought I had
156.
trips.
Here you can see the high conviction breakdown as we saw imbalance created and the market move lower with conviction. And then you can see we kind of tapered off.
Dude,
We
about to
lost
get a
some of
straight
that
flush.
momentum where we're seeing lower lows and lower highs. High energy to the downside shifts into this more horizontal overlapping rotational type pattern. And we're currently consolidating around 150. So holding below that pivot right
I
now,
gotta slow
again,
play
just a
this.
sign of weakness, further weakness. And this is, again, just a snapshot in terms of more granular look at price activity. Here we're stepping back a little bit here. We're looking at hourly candle charts here, and this chart goes all the way back to when we were topping out a very similar pattern. You can see top left to bottom right around 175, and you can see areas of consolidation that formed at lower and lower levels going back to the end of July, and currently again balancing below this 150 level, or holding below the key area associated with this area balance right now, which is 150. As long as we remain below 156, still a very bearish pattern. No indication that that has really bottomed out or started to reverse itself. But similarly,
I almost went all
what
in.
we were just talking about a
I
minute
think
ago,
you'd call
you've got
that.
weakness on the more intraday, more intermediate
Dang it.
time frame, but a little bit of strength on this longer term.
I need
As
to
you can
close to these
see,
balls.
high conviction throughout the end of 2020, the spring, summer, and fall of 2020 into
Close on these
2021. We
calls.
went a little bit more sideways. Now the recent breakout we saw above 173, a bit of a disappointment for the bulls, but we're still holding above this 140 level, which I think is key. Again,
5
you
minute
can see
back to
it's
VWAP.
sort of the pivot for the range we've been in over the last couple years here. Again, a little bit of a disappointment to not see follow through to the upside in terms of that
Not a buying
173
power on that,
level, but
that account,
I
so
think the bullish narrative still remains strong on this
might use the other
longer-term
account.
trend. Short-term DRI, though, you can see it's been coming under pressure.
And as you can see there, this speaks to its 7-week sell-off. It has closed lower for 7 straight weeks, which is pretty brutal. And I think that you highlighted something that's very important, that's time frames, because as we saw that clear stair-stepper pattern down, this looks a lot different. So what are you watching now into this earnings event?
Well, you have to keep an eye on a couple things. One is, again, that shorter-term trend, which you can see really well-defined. Speaking of that staircase pattern to the downside, notice how we took out the 50-day moving average, took out the 200-day moving average. Again, I mean, you can also see RSI, which has been a little bit weak here and supportive of this downward trend right now, trying to inch its way off this lower level as we get a bit sideways. But Rick DeCat, your normal chart master, always talks about how RSI is not necessarily a great indicator as we head into the earnings event. So I'm kind of discounting the market's been managing to hold above. So DRI definitely showing further signs of weakening here, not only on that short term, but also on the daily relative to these longer term averages.
Yeah, and really unable to catch its footing after its last quarterly update. We've just been, like you said, clear stair-stepper trend to the downside in Darden Restaurants. So really great breakdown on both of these names here, Ben, ahead of course, their earnings events. Now when trading this name, Alex, just considering the fact that we have seen this weakness, this pullback, but in the restaurant space overall, this name is still hanging on to its year-to-date gains. So walk us through a more neutral-leaning example trade.
Yeah, looking at a traditional earnings-like strategy in which the investor would seek to sell premium around the current share price in a neutral fashion, looking for an overestimation of what may happen around this event. So we're looking at Iron Condor. You can see it over my shoulder here. One thing to note, no weekly options in Darden Restaurants. So this thing has to go out until October, that October 20th expiration, which is the monthly cycle. It's almost a full month away. Looking at selling the 140, 135 put vertical alongside the 155, 160 call vertical, collecting $1.75. That's pretty close to 1/3 the width of the strikes on a $5 wide spread. It'll be roughly a 2-to-1 risk-reward ratio, a little bit better than $325 in risk to make $175. And you make that 175, these options expire worthless. They're most likely to expire worthless. They're out of the money. Where are they out of the money? In the middle of the 2 short strikes. So between 140, 155, you can see this plateau on the risk profile. That's where the credit received is the max profit, as well as, of course, best case scenario here. So when you zoom out, then you can see the break even, subtract from the short put 138.25, add to the long, or to the short call rather, 156.75. Those are the two break-even points. Risk beyond those points limited to 325, and that's outside the long strike. So below 135, above 160. Notable, this is of course a little bit longer term because of the nature of what's available, but also because it's a little bit longer dated. You can see our break-evens are a good nearly $10 below, and let's call it $8, $9 above Jenny. Well, the market maker move is only like $5.50. So it's way outside that market maker move, but the expiration is also a month away. So there's plenty of time for that move, even if it doesn't happen, let's say, from this earnings, to happen in the next month.
So we have some wiggle room here, and I do think it's important to consider the outside of the market maker's expected move, because that seems to be a theme, at least this earnings season. Lots of outsized moves either to the upside or to the downside. But that does it for this segment. Now, coming up next, it's time for FOMO. We are looking at Adobe, as analysts still feel optimistic on this name following their third quarter update. Despite that selling we saw last week, we'll discuss that and more coming up next.
Rejecting VWAP there. Chart coming down a little bit. See spike and break VWAP 130. Couple minutes. Alright, still building that right support. First head and shoulders. Right shoulder. Wonder if it's bad news birds. It's halted. Big RSI divergence around the day. A 5 minute. That was a nice indicator that this won't just keep flushing. Probably wouldn't, at least. That should have helped me in my calls. That have been shaken out. I averaged back into some puts there. A pullback. Or calls, I mean, sorry. I'd waited. These calls even I picked up here that were late, they're up like 90%. Like I can just wait. The lack of patience. Buy break and BWAP. That is it. Alright, still consolidating. Low VWAP. Split it. I guess the kicker was out there. Crappy kicker crew.
We've seen the performance for SPACs over the last couple of years has not been great, and that's probably why we are starting to see IPOs coming back into fashion, where SPACs are kind of by the wayside at this point.
Gosh, and SPAC was all of the rage several years ago. It was like one of those buzzwords we just kept saying, and now it's like completely obsolete at this point. But I mean, great move in Instacart, no doubt, not too shabby, seeing shares up 33% on your public debut. So nice move higher at Instacart shares. We will leave it there. Kevin Green, senior markets correspondent here for the network. And I'd like to bring back in Alex, and it's time for FOMO. So we are looking at all things Adobe here, which was initially lower off the open. Now we're up about 0.8%. Not a huge move to the upside.
AMC moved up also.
But this name closed down 4%, over 4% on Friday after its earnings that
down
were
2% now.
Strong. But we were just sort of saying last week the bar was set so high.
Yeah, it's a situation where this name's gotten caught up, rightfully maybe, in the AI kind of excitement, and the bar has been set not only high, but maybe unattainably high for some of these companies to show that the AI is really going to do something for them. And Adobe may be one of the first to actually show you a product that is better because of AI. It's not just selling chips at a very impressive rate. See NVIDIA for that, but this is a company that for many years, we've said this every time, really changed the way software business was done. Is it kind of was one of the key cornerstone pieces in that software as a service model, and really improving both shareholder and stakeholder kind of results as a result of that, by having more consistent, projectable returns and monetization. But at the same time, for the consumer, you were able to get the most recent updated version of the platform at a more affordable price over time. And so a lot of things went well for Adobe before it peaked out with the overall market. And last year was tough. Last year was the first, I think, major storm investors had to weather in this company in several years. The stock lost well over half of its value and is still, working its way back. It has regained quite a bit of value so far in 2023. Jenny, it's been a pretty impressive performer, starting to get back some of that in the last few days. But this stock was almost $700, and I think sometimes we get caught up in how well they're doing year to date. and don't realize how far they actually fell in 2022.
Kings, maybe spades they
that's
have.
a really good point. Even with this average street price target right now of $605 a share, that implies, I mean, 13% upside.
I just check
but
it.
nowhere close to where
dude,
we
I hope this
were,
get bad.
obviously, just given some of
No.
the overall pressure this company
No.
But some specific analyst news we got today is
After all that bluffing, you're not gonna. That's smart. It was well played. You played it well.
From 565, so even
I've
more
still played too
optimism
much.
than the street average, with a buy rating saying that the shares remain a focus list selection for the firm, which is one of those
I've still
buzzwords
played
I
too
know you
much.
love, Alex. But the analyst did say Adobe, as usual,
You
surprised
could've
to the upside
called
with
something
their
big with
third quarter
3
results
queens.
last week. This analyst thinks
I'll
the
do
company
your
has
calls.
positioned itself at the center of the exploding market for digital video
Come on.
content and advertising creation and management. Now, to paint a picture of their results,
Balls
here,
on
they
that
did
head and
beat on
shoulder?
top and bottom line in the third quarter. They
You're just
issued
scalping?
inline forward-looking guidance, so not weaker, just pretty much what they had been set forth to do already. The one major concern from analysts, although most did raise their price targets and revise their ratings to the upside following this result, was rising costs weighing on their near-term free cash flow generation. Well, they also worked to justify the high premium for their pending Figma acquisition, which is, of course,
It's
facing
gone.
that antitrust scrutiny. However, they really continue to monetize their AI opportunities very
can't believe
well.
that.
That's been echoed by pretty much every analyst that covers this name, and they do see favorable customer and partner
You average
trends
down
at
shop
this
calls?
point. Also,
Careful
what was
averaging down
amazing
on
to me is
calls.
they were able to expand their margins in their
Already
third
just
quarter
long
despite
options.
higher costs that were associated with AI.
Naked long
so
options.
there could still be a gross margin
Dude,
impact
deep
going
in the money or
forward
have a
given
ton
the
of time.
costs to generate all of their different AI offerings and investments in video and 3D. But the fact that they were able to still come out in positive territory in terms of their gross margin impact was, I think, a huge positive. Morgan Stanley actually did say they maintained their best-in-class model, including a maturing digital experience segment, and for that reason,
You say
they are
short-term,
also
what
extremely
time frame you looking
optimistic
at?
on all things Adobe shares.
That head and
But
shoulders is pretty
Adobe's
obvious
still
on
up 58% year
probably
to
most time
date.
frames.
It's pulled back about 6.5%
Above, like, 30
from
minutes.
its high here. It's up 94% from its low. And something I always think that's so amazing about Adobe is it's difficult to learn and to master. It's complex.
Can't believe I
You know,
just
creative suite
checked.
software is definitely one that takes some time and skill to understand. But I
Ace.
did just use the beta
Beta
rollout version
flush.
of their Firefly, which is their AI. They coined it generative AI for everyone. It is so easy to use. So if you're unfamiliar with Photoshop, which is a relatively, I'd say, challenging software to sort of navigate, this does make it a lot easier. So I can speak to the fact that I think that's a good thing to get new customers. I also think that right now expanding your product offering outside of people that are just, Photoshop experts is huge.
Yeah, Adobe is a niche product still in general. It's very design oriented, and while that's a large niche and it has a large target market, it isn't getting every single person to download its software and pay for a membership on a monthly basis. That being said, if they can make something a little bit more accessible, to your point, that they can also deliver a reason for me to want to download that and need that, then they only expand their addressable market. From that. One thing we have seen in the past few years, if you look from 2017 through, let's say, 2021, where this stock was really doing well, is it was consistently delivering not just double-digit revenue growth, but in the 20s, 20% revenue growth. Last year was about 11.5%. It's expected to slow to about 10% for the year this year, and then it pops back up to 12% going forward. To me, that indicates that, yes, it's still an impressive company, but their growth rates are half of what they were. It's decelerating in terms of that growth. It's leveling off. But what does that mean for what you're willing to pay for this company? Interest rates are higher now. Growth is slower. To me, that would maybe
moving
mean
up
that
here.
you pay a smaller multiple. And so if you look at it over the last 2 years,
This is the way.
it's actually about in line, if not a little bit high, in terms of its historical multiple. If you go out over 5 years, it does come down a little bit. So the street's starting to make those adjustments in real time as well. It's certainly a company that's done a lot of good things, but it is a hefty price tag at almost 30 times earnings.
And to go on to that, it's also expensive as an individual consumer. I mean, this is software that you would have to have a good reason to justify spending. It's costly. I used to pay for it in college, and I had like that college student discount. But right now, I'm on an enterprise account because it is expensive to download that entire suite of all of their products. But trading this name here Walk us through what you're thinking, because right now we do have that earnings catalyst behind us, that massive day to the downside. I say massive, but massive for Adobe, obviously. And now we're starting to see at least some signs of shares recovering those losses from last week.
I looked at buying a call condor. This would be a bullish strategy. I think that there is excitement about Adobe. The stock has pulled back, and so looking for a way for investors to basically get exposure to the upside in a risk-defined manner. And so what we looked at was buying a $10 wide spread, the 530, 540. So one strike is in the money.
I'm gonna pause this. What are they getting, October 20? Hey, at least they're giving us almost a month. Oh. Buying the 530 call, sell 5. What kind of trade is this? Buying the 555. Selling the 550. Dude. The legs they put in their trades are great. Oh. Five, sell 5. 530. Sell 540. Okay. Oh. Try to put in the whole pot. I guess the bluff worked anyways. Alright, I think this is it. Oh, great. Now we're behind. Alright, I'll do it. I'm gonna set up the paper trade. Call. Here it is. Oh, Aggie. Sell, buy, sell, buy, sell, buy, sell. Is this right? $16,000 debit? That's seriously what the trade he was doing? Doesn't seem right. Oh, I'm doing 10 of them, I guess that's the difference. Alright. And a 9. Cart came down, shoot. Let's build a little inverse cup here. Nothing. See if we get a bounce off the low of the down cart for an inverse handle. That's where I'll exit. Ripping there, look at that. Oh boy. Alright, new low. First cup gonna play out. Bounce around SPY. Bounce on cart. Oh, not really, not yet. I wasn't paying attention. I would have closed it this break. Time I got to it, it's too late. Got a gap up there, SPY. You wouldn't happen to want to fill that today, would you? Whoa, there's your bounce on cart. Straight out there. Just straight rocketing. Put a sell order for 38.90, I think. Yeah. Oh, I missed it. I didn't want a market order, just going was too volatile. Get it. Oh, give me a good fill. All the handle we're gonna get. I'm out of them. The cart was fun. Thanks for playing. AMC down 1%. Almost even. SPY just going wild. Actually back green on this. That's crazy. Just with one contract. Closing this one. closing out of some other calls. They're up pretty big. Was out of 3. Okay. Closed out of most of my calls. Closed them out of the day trade account. Got green, which is nice. So I'm saying this was like, you don't always get this big a reversal though. Very well could just get this, then a bounce, and then just chop into close. So I guess you can wait for this every day, but you just might not get it every day. But yeah, you could get, yeah, I got chopped out a little bit today. Using the 15-minute. I guess you're just trading weeklies. Plus weeklies, yeah. Oh, 1020. Are you doing all the October expiry? I guess that helps with your success. Not quite so volatile. So I have 3 calls left from the Fidelity account, so I can't do dailies on Fidelity, so they're for tomorrow. Even the ones for tomorrow though, they're up 30%, and I didn't get them till, I don't know, like right here, break of VWAP area. So really, you can, moves happening, you can just be patient. Oh, I don't want to get kicked out of that table. Someone, AMC fell in the gap, almost break even. I like the date. If you're trading stocks that are more liquid, like I think shops options are, could do the weeklies. Usually you'll pay a little less premium. AMC's almost break even. But yeah, if it's not as liquid, monthlies are better. AMC filled the gap. Almost break even. Oh snap. No hearts, no diamonds. I don't want them to think I have a straight. Scare them off. $3.5? What were you doing all in? Heck. Yeah, that's kind of messed up. I do daily on Given I'm doing it on cash now, maybe if I had it on margin and let me do it, I'm not sure. It's like on Webull, I can't market order. It's buy options most of the time. It's a volatile market. Spreads are what? Like what? The spread on SPY options are a penny. We're tighter than the stock sometimes. But yeah, anyways, that's kind of annoying not being able to do market orders on that. Sometimes I can, but usually because it's too volatile. It doesn't mesh well with payment for order flow. Your front menu as well. I guess I could hold these three for FOMC tomorrow. Thought. See where we close end of day. Blurry. I don't think I'm dropping any frames. Maybe it's your connection. Oh, never mind. It's YouTube. Might get a little buffering. Yeah, I see that. It looks fine on my end. But there you go, should be back. There's a straight out there. Got a call too. Oh, what could you have here? Those you could have a 9. Not worth it. Wonder when we'll get the birds news. Dink. Just say hey to you when I see your eyeballs. Assuming that's what you're saying is watching. I don't know how to respond with my own set of eyeballs. There, I just did it. I see your cards. Yeah, I think it just buffered there for a little bit. Why must I keep building this cup? 442.64. Oh. We could go today. Open 442. Very nice. Pocket Jack should have raised more aggressive. Yeah, cart flushed through the lows there. Made that handle so quick. Oh boy. Nice. This guy all in. Do it. Yes. You have that straight there. Oh, landed. Oh, 3-6. Air kicker. That was a call, Annie. Is that a higher kicker? You didn't have it straight. Got a pair of aces? All in? Apple pushing this up. Sell one more of these calls. Yeah, big reversal on Apple. Apple's hitting its high from yesterday. Ah, there's a king. Oh snap. A lot of good hands. Most people don't fold. And Let's see, has pocket queens. Now he knows I have 9. Scared. Who was it? This. Got a queen. He's got a queen. Or you could have a straight here too. Didn't believe me. Oh my gosh, look at these hands.
Sort of market change in the composition of what's being sold, and that has sort of supported the average price of the median house sale overall in terms of price there. So that market looks a lot better than it really is underlying it. So yeah, these high interest rates are going to hurt. I think the economy overall, yes, is looking pretty decent. There's some warning signs on the horizon, but the unemployment rate is low, and I think the Fed is going to feel fairly comfortable about pushing some more pressure and pushing these interest rates even higher to try and get inflation under control. So I think they're going to be in a very confident position to do that, and I think we might even see them surprise the market tomorrow and actually have a small increase tomorrow as well.
So at this point now, with a higher rate environment for longer, even if they stayed exactly where they are today, but you anticipate some more hikes, what would you tell folks how to position a portfolio to have a winning portfolio, or at least hold their money, the principal?
Well, hold on to the money. Basically, short-term U.S. Treasuries are looking really good. I've said this a few times before as well. Basically, very short-term dated U.S. Treasuries up to about 6 months are returning over 5%. I think that's a really interesting place to be. I can't remember when you could last get 5% return for taking absolutely no risk. So that's a really attractive end of the market to be in. If we do carry on seeing these interest rate hikes, I think the tech market is going to be hit quite badly. We're going to see a correction there, and maybe the broader market as well is going to have some real downside risk as a result of that. But I think these interest rates are going to keep going up. Inflation does not seem to be tamed. Quite the opposite. We're seeing energy prices keep going up, and that's going to put pressure on the broader market. But the Fed is going to be in a good position to do that because they're looking at the economy overall and saying, yes, there's some small signs of weakness over here, but the basically foundations seem to be very sound, and the U.S. economy will be able to basically survive that quite handily.
So with the market likely to put, because you said tech could correct, you'll have this higher rate environment, the downside risk it could be there for the broader market. So where are the opportunities? You did say short-term bonds, treasuries. Are these other pullbacks, if they come, opportunities? Where would you say in equities would you say is an opportunity when it pulls back, whatever?
Well, when it pulls back, I think what you have to basically wait for is the Fed to make this turn and this pivot to start to cut interest rates again. And then things start to become really interesting. And I think that's the point at which you have to jump back into the market. But that seems to be receding further and further into the future. So if you'd asked me at what point will that happen 6 months ago, I would have said, yeah, right about now is probably when it's going to happen. And the Fed is going to start to cut rates. However, the inflation has remained more stubborn. So that is receding more and more in the future. And I would be waiting for that, basically sitting on the sidelines of the market, waiting for that. And basically saying jump in at that stage when it becomes clear that the Fed is going to go on an extended rate cutting exercise the way we saw a few years ago. So that's really the waiting point. But in the short term, I think there's a whole bunch of basically, I think the US dollar is looking really good. That seems to be strengthening, and higher interest rates will push that further. So for the more adventurous kind of investor, that might be an interesting thing to look at, is basically that kind of FX kind of exposure, and say I'm going to bet on the dollar against the euro, against the yen, against the other currencies.
Right. And where do you think the gasoline story, oil, does that fit into your big picture? Are you looking at other sectors? I mean, someone came on today and said staples and utilities. And, you know, is there anything else that I've left out here that you want to discuss for investors?
Well, staples and utilities, I think the major oil firms are going to look really interesting. It seems the trajectory of oil prices seems to be going up and not slowing down. Who knows what's driving that? Those
Pocket
things seem
six
to
is
go
well
up and
done.
down, but they seem to be on that trajectory. OPEC and OPEC Plus basically have cut down their
Why
production
don't I get the
targets,
change?
and so that's going to keep
Did
supporting
I get the
oil
change there?
prices. So I think the oil majors are looking
Oh, I guess
really
he
good.
folded right away.
Staples, utilities, things like that, certainly. The banking
Didn't go
sector, I
through
think
a-
there's some bargains to be
through a
had in as
raise.
well, because they have actually benefited from higher interest rates as well. So those banks who are positioned on the right side of interest rate increases have done very, very well indeed. So those are the sectors I think that are interesting, but you have to really pick and choose your battles there
AMC
and
is
be fairly
green.
careful about getting that right.
Right. Octavio Morenzi, great to see you of Opimos.
He's
Glad
almost
you were
green.
here, Octavio. Thank you. Coming up next, Kevin Horner standing by for Technical Tuesday. He'll explain why MetLife stock is about to cross a very important level that he's watching, and he'll
Got a lot of
explain,
options
and
for
he has a
trades
few
there.
other things to tell us as well. Coming up.
Could have raised. Well, I'll give this one. Wasn't aggressive enough for a bluff. Can't click it. Whoa. Lag spike there. Oh my gosh. And there's a queen. AMC's up 1% now. Lucky, lucky, lucky. What's up, Jay?
Results and affect product availability. Wells Fargo has underwent ratings on Clorox.
Undergone.
Underweight, and D.A. Davidson rates the stock as an
Underwent.
underperform. MGM Resorts, also a victim of a cyber attack last month, and its stock trading lower today after a New York Post reporting indicating that the company could lose out on New York casino licenses after the ouster of MGM Grand executive Scott Zabella. MGM had previously been the one of, well, at least one of the front runners to win a license here in New York for a New York City casino. It's been a big
Let's come down here a
topic,
bit.
state-run license
I'm gonna hold these last couple calls.
in the spring.
Maybe
And
till
Base
tomorrow.
Energy stock is up nearly
For FOMC.
5%, coming off a 52-week low yesterday after a price target cut.
I want to see what how end of day ends up though.
Company's director disclosed a $4 million
Keep my exposure to the long side.
Enphase Energy shares are down
Didn't
more than
retest the high of the day, so
And in the EV
we still have the
race,
opportunity
we're
for that.
watching NIO down more than 10% today after the company issued a $1 billion in convertible senior notes due in 2029 and 2030. So NIO plans to use those proceeds to repurchase existing debt securities and improve the balance sheet. Shares of NIO down nearly 60% over the last year.
Kind of risky, but
And We
A
are
2 could come
seeing
out.
shares of
I think so.
Bitcoin or Bitcoin trade moving
Or
higher
a
today.
3.
Right now it's at
Maybe another 3.
27,255, up 1.4%. Let's keep things moving along. It's Technical Tuesday. Joining me right now, Kevin Horner, Senior Manager, Trading Services Education at Charles Schwab. Kevin Horner, glad you are here. So let's start off. I know you're looking at the S&P 500.
Yeah, you got this straight there.
Earlier today,
Nice.
Jay Woods was saying he was watching 43.50 and then way down below 4,200. What levels are you watching and why?
Yeah, that 43, 4340, 4350 area of support for longer run investors, more intermediate term than, say, the last couple of days here. That's a level that I think a lot of traders are eyeballing. That's the low we got in August. And, a matching low following a fantastic rally, kind of validates the idea of consolidation after peaking here in late July. So I would not be at all surprised to see that support hold. Now, on a shorter term basis, it's also quite interesting. We got a nice little bounce today at the 44.15 level, creating a nice little candle tail, a little wick at the bottom of today's candle. And that might be giving intraday traders something interesting to keep an eye on. I'm sure we got a little bit of buying in advance, thinking, hey, maybe we got a little bit ahead of ourselves with regard to tomorrow's FOMC decision. So a little bounce midday. I'll be really intrigued to see if we revisit the intraday lows here and get back to that 43.15 area that we saw pretty early today. That's the first area. And then, like you said, at 43.40, 43.50 be very interesting. And our last guest really put a thought into me. We're talking 99% likelihood of a pause tomorrow, but the idea that they might actually give us a 25 basis point hike tomorrow could really put a scare into the market in a short-term basis with so many people positioning for pause. That would be a really quite the shock from what we've seen of late.
All right. Let's turn our attention over to your next a real name that you're watching, and that is MetLife.
Sure.
You're monitoring this stock, MET. Why?
Couple of key reasons.
Well,
short-term traders probably love the fact that we broke out in the last 3 days. So we've got a trade that looks like we've moved to new highs that we really haven't seen since February of this year. So moving through that level was insightful. And the short-term trader would just say, hey, we have a little ascending triangle, 4 points or so that got broken with this move. And we've managed to hold for the last 4 sessions here. So short-term traders like that. But there's another scenario playing out, and that's what you're seeing with the lines on the screen here. A 50-day moving average upward sloping quite nicely into and close to the 200-day right now. So over the coming days here, we're going to see the 50-day moving average providing us with the so-called golden cross that a lot of longer-term traders give some serious credence to. Now, it doesn't imply that the move has to happen imminently to the upside, but it does show a shift in what had been going on, which was a pretty decent downtrend working. So now that things have kind of gotten to a point of reversing that downtrend, you may very well see traders of longer windows of time with a little bit more comfort exposing money to this type of position.
Right, understood. Okay, and last but not least, Jacobs Solutions is another one on your watch list. What levels are you watching?
Well, this one's all about the pattern, I would suggest. Now, of course, today, with a little bit of weakness, what we've had is a potential bullish flag situation playing out. We had a great gap higher back here in August on the 8th, and that was coincident with the earnings announcement, second quarter earnings on that day. And since, it's just undergone a little bit of a drawdown, but in reality, it's an appropriate move to a major area of support, which in this case would be the 50-day moving average. And on that chart, what you're looking at is really a channel of lower lows, lower highs in the short run, but the position has shown a willingness to hang on to support right around 130 and the 50-day moving average. So from a pattern standpoint, it's one of those situations where traders who are bullish can look to enter nearer a 50-day moving average, which gives them excellent risk versus reward if it holds. Of course, it also means that if it breaks down, they're going to move on very quickly. Maybe a close for a day or two below the 50-day moving average would kick those traders out, and that would be perfectly fine. Alternatively, though, a trader who wants a little bit more confirmation could wait for the move through that downtrend line on the upside, and that would be somewhere in the neighborhood of 134, 135 on a closing basis. Yeah, they'd be paying a little bit more to wait and buy up there, but it's also a little little bit more potentially likely that their position moves in their favor. So as usual, a couple of ways to attack a position like that, but it's all about your comfort with the position, of course, Nicole.
Yeah. Kevin Horner, let me quickly ask you about your expectations for the Fed tomorrow. I mean, we just had on Octavio Morenzi, who is hoping for another quarter point at least. What are you thinking, or what are you hearing?
Well, at least in my circles, I think the expectation is for a pause. Now, whether or not I think that that's the right decision, I'm not going to provide any speculation to that extent. However, I think it's most likely we do get that pause. I think the market would react unfavorably in the immediate future if we did, in fact, get another hike here at 25 basis points. That might be warranted. It might be necessary. But the way that the Fed has forecasted
AMC really woke up there, 3.5% now.
all along the way certainly gives the impression that they're going to pause this period, but they've also previously told us, Nicole, that they are going to
really
be
bounce right on their support there, right on the
and
neckline of the
we
Head and
clearly do not
Shoulders.
have inflation the levels that they are wanting. So I think it certainly is an interesting idea, but I'd be shocked if the Fed was
Hung out below there
willing
for a
to
bit.
literally shock the market with a hike tomorrow. That would surprise us all, I think.
All right, Kevin Horner, Charles Schwab, thank you so much. Really appreciate it, Kevin.
Thank you, Nicole.
Great to see you every Tuesday, folks. Coming up, we're talking Disney. So the stock is
Yeah, that's great for AMC.
near 3-year lows today. News that the company is doubling its investment in its parks over the next 10 years. A lot to talk about. What happens to BBC,
Whoops.
Hulu, ESPN? Do they all get spun off? We'll talk more about that next.
GME doesn't have to move. It's going to consolidate, probably keep coming down. We have the makings of a royal flush here. Or absolutely nothing. Dang. Dang. Got a king? What? She got there on the flush? So lucky. She was barreling down with one diamond out there. I guess she had a king too. Just built my own trap. They just had strong hands. Nothing you can do. You bluff them out of those hands. "30 minutes to power hour." Why weren't you all in? You're doing it again. Action. Well, I think my queen's having a well. All in UPS? Is that on the catalyst of them stopping the strike? Or just a long-term play? Yeah, it's getting nice. It's getting pretty close to a pretty big support here. Went from 155. What's your plan with it?
But I don't think Wall Street really cares about the parks business so much because they already know what that business is doing. They already see the profitability there and they see where that is growing over time. It did slow for a bit. But the real question is what are they going to do with the streaming business and what are they going to do? You mentioned the deal with Charter. What are they going to do with these carriage fees and all these deals that they're going to have to cut? That is really the one to watch.
Yeah. Can you speculate at all what you think might be happening? I mean, we started to hear a little bit about ABC and the possible sale of ABC and some other parts of Disney. Does that seem likely or unlikely at this time?
Boy, you know, thank God I'm not on Wall Street. I wouldn't want to bet on this either way because it seems Disney keeps changing their minds and giving different indications of what they want to do. What they have told us is that the linear TV model is still very important to them. But at the same time, they've also said that they know they have to go direct to consumer with ESPN at some point. So that's a very hard business to balance when you have to do two business models where one is growing, one is not growing, and the one that is growing is still losing a lot of money.
Yeah. And when I think about the value, I mean, ESPN, as you just said, they do see the strength of linear television, or at least its value, but they also want to try and go direct to consumer with it. I mean, are these all
Plus 150, 155.
to Disney? I mean,
Just like a swing trade with shares.
Put that aside because that seems like it's very valuable. And how else do you quantify the value?
You call my all
of the
anything?
other things? ESPN, Hulu, Disney Plus, ABC.
Yeah, it's a great question. So,
you know what I mean?
It's hard to know because we don't know how they would roll out an ESPN direct-to-consumer service. What would the cost actually be? Which content would it contain and not contain?
Oh my
One of
gosh.
the things that we're hearing from the distributors is Disney continues to take more of the content out of the pay TV bundle and put it into streaming. Well, that doesn't help the distributors who are licensing this content from Disney. So I think eventually, if I had to guess here, I think Disney has to spin out some of its digital properties or sell off some of the traditional TV networks and really refocus their business again. They're in far too many businesses right now with two different business models, different means of distribution and licensing. I think they need to get back to their core of who they are and what they do well.
Right.
You're saying first swing trade on it?
So selling off the networks, that seems very, clear.
Are you
Spinning off
playing the shares or
properties, what could that mean?
Well, it means you separate the costs associated with.
No, which names? I mean, like which
I think you have to look at ESPN. You have to look at Hulu, right? The three core fundamental digital direct-to-consumer services they have.
So I'm on it. All right. I just wanted to make sure I wasn't missing some other digital property that I didn't mention. All right. So I'm going to leave Disney there because obviously, Bob Iger, it's a work in progress and a bigger job than he anticipated. We just got some breaking news from Warner Brothers about a live sports, a $10.
Thanks, Mr. Invest. Appreciate it, man.
Going to be available.
Market's kind of slow. I mean, not a whole lot of excitement
I mean, sports seems to
for
be
retail in the market, anyways.
where it's at, right? Amazon Prime Thursday now has football.
I don't like promote or do a lot of stuff to grow an audience. I don't do clickbaity stuff or I don't go attacking other YouTubers or I just do my thing and whoever hangs out's into it, whatever. But I appreciate that, man.
Well, not surprising at all.
2 weeks
WB
options.
already told us they were going to do this. They told us that they felt their sports content had a lot of value. Then they were going to charge for it. This $10 introductory price, is this the price that's going to stay for the next year? What's it going to look like 2 years from now? Because all these services are raising rates. How much of that content?
It's not a very big mover though. Are those options worth it? Expecting a pretty big bounce.
So we're going to have to watch what the uptick is on this, and does this help overall churn and retention when it comes to
I'm not trading UPS that often.
Dan, let me
I think last time was probably for like earnings.
to you, and I'm not being facetious because I think that this industry is a work in progress, and there's a lot of speculation and a lack of clarity at this point. To the point of Disney, and even to Warner Brothers Discovery. What do you know? And I say it because you don't know. You can't know some of the questions I've asked you. What do you know that seems very obvious to you? Is it Netflix is the best?
Yeah, what did you know?
Linear TV goes away. I mean, what's my water cooler takeaway 2 or 3 statements. Dan Rayburn spoke and he told me this, and I believe him because he's immersed in this industry. Tell us what because you're the expert.
The media market is melting down.
All natural.
It is not business as usual.
Yeah, man.
Linear networks are changing the way they do distribution. Pay TV providers are looking at what is valuable to their business. The fact that Charter came out and said, well, we might just get out of pay TV completely if we can't.
All right, you said a lot of nice things. I like your UPS play now.
Profitable enough. This is not business as usual when it comes to
it is a nice support, though.
Distribution and licensing of content.
Close to it, at
over
least.
the next 2 or 3 years, we're going to see that shake out and see what the new distribution and licensing models really are.
I'll bless your UPS trade. How about that?
All right. Dan Rayburn, thank you so much. Streaming media
good to see
analyst. It was good to speak with
You're
you.
spying at the high today. Bull flagging up here now.
We have 500.
My. Called. Oh my gosh, I beat that.
You could think getting commission-free trades is as good as it gets.
I was completely throwing it away. Oh my gosh. You're kidding me with a pair of twos? I thought I might break that 180 to pin them. Yeah, FOMC could definitely move it to the upside. Or down, but yeah, it's pretty close to support, I suppose. It's not popping up. If you're on mobile, become a member. I think you have to X out the chat, close the chat down, and then you can. You should see join. I think there somewhere. I wasn't high card. I had a pair of twos. Okay, I had a pair of twos. It was not high. It's a little too aggressive, maybe. This guy running. Pair of aces. Wow. Thanks for calling. UPS 20th this month? Tomorrow? Yeah, it might be tomorrow. You checked, Mr. Invest? Or is it next month? I mean, $10.26, so not the 20th. I don't think, unless these are just estimates. E-Trade saying it's the 26th. Wow, SPY, look at that rip. You said E-Trade saying the 26th of October. That looks like a hard date. I don't think that's an estimate.